quorum. Let's see. I see me. God, a lot of folks on here. Oh boy, here we are.
Not yet.
Okay, thanks, Linda. Let me know when we do. Let's go ahead and call this March, what the heck day is it? March 3rd meeting of the Police and Fire Board to order. Let's go ahead and see if we've got quorum. Let's do roll call. Andrew just sent text. She's out on a call. Sunita, are you here?
I'm here.
That's great. Howard, are you here?
Present.
Oh, great. Eshfar, you're here?
Yes, I'm here.
Great. Dick will not join us solo afternoon. He had another emergency board meeting he had to attend to. Franco, did you make it?
No, he's not here yet.
Okay.
No, I'm online.
Oh, great. Thanks, Franco. That's
I'm just
four.
stuck on
Dave?
87.
Oh, it sucks to be you, dude. And Dave, are you here?
I am.
That's great. We'll notice that we have a vacant seat on chair land, so that makes 6. We need 5 for quorum. So let's go ahead and get rolling. If we hit anything big, I'll make sure we've got probably more than quorum just to make sure that we really have a legitimacy. I think there's only one tricky issue on the agenda, and Dick has asked for us not to hear it until he gets here. So we won't even get to that for 4 hours probably. Let's see. Orders of the day. So, in general at Zoom, we managed to maintain a very high level of Zoom functionality. So feel free to interrupt the speaker if you have a question. That hasn't proved to be a problem in the past. We run a fairly loose ship here. We're going to be hearing this issue about felony forfeiture. And when that comes up, because it involves basic fundamental constitutional rights having to do with due process and so on, I'll revert back to Robert's Rules of Order, and we'll run a very tight ship to make sure that everyone is treated fairly and that we all have a right to get involved in that. So let's see. Yeah, and then don't forget, we'll have to, and I think Maytack said for the last time we'll do AB 431. So we've got to waive sunshine on a couple items. There was, so just so you guys know, this is a weird agenda. It's really long, and there aren't any really individual long bits like a single item we're spending a half an hour on, but I swear to God, we're going to be here till 1 or 2 because there's, as Roberto pointed out, there's lots of little 15, 20-minute things, and there's a lot of them. If you remember reading your deck in the last couple of days, there's a lot of stuff, and this shows up in the sunshine. So I'm looking for a motion to waive sunshine item 1.7 A, which is under the consent calendar. Item 2F on asset allocation by Makita. I'm guessing they sent us some updates late. City's pre-funding option, I'm guessing that also was some late documents. That's 2G. 4E, board medical advisor. I've been working on that with Roberto. That's happening in real time. And 4G on our budget. So do I have a motion to waive sunshine on all those items?
Motion to waive.
I have a motion by Howard. Do I have a second?
Second by Sunita.
I got a motion by Howard, second by Sunita. Let's go around. Andrew's on call. Sunita, how do you vote?
Aye.
Howard, how do you vote?
Yes.
Ashfar, how do you vote?
Aye.
Dick, Dick's not here. Franco, how do you vote?
Aye.
Dave, how do you vote?
Aye.
And I vote aye. That's 6-0 in favor. All right, let's see what I got to do next. Hang on. All right. Okay, so we made that one change to the consent calendar. Does anybody want to pull anything off the consent calendar? If not, I'll entertain a motion to approve the consent calendar.
So moved, Wilson.
Great, I've got a motion by Dave. Do I have a second?
Sure, I'll second, Sunita.
That's great. I got a motion by Dave, second by Sunita. Let's go around the table again. Sunita, how do you vote?
Aye.
Howard, how do you vote?
Yes.
Ashfar.
Aye.
And Franco, how do you vote?
Aye.
That's fine. Oh, thanks, Franco. Dave, how do you vote?
Aye.
And Lance votes aye. That's again 6-0. Hey, Prabhus, is there any reason to, let me think, we're missing Andrick and we've got all of our financial gurus online, right? I'm here, well, I'm not a financial guru, but Sunita is, we've got Sunita and Ashfar. Yeah, let's go ahead and move forward, Prabhu, over to you. We've got all of our financial folks online.
Great, thank you, Mr. Chairman, and good morning, trustees. Yes, we do have a number of agenda items today, including in investments, and we'll try to get through them as efficiently as possible. And before we actually get to the performance presentation and then to asset allocation, probably on top of everyone's minds is the Russian invasion of Ukraine and its impact on our portfolios. And so I do have some specifics that I'd like to share with the board. But before I actually get to the impact on our portfolio, we are actually fortunate to have with us this morning Steve McCourt, who's CEO of Makita. And Steve actually has to jump in a few minutes to another meeting. So I'm going to invite Steve, with your permission, Mr. Chairman, to address in general terms the impact of the Russian invasion of Ukraine. And then once Steve's done, I will actually come back and give some specifics in terms of portfolio impacts.
Great, nice to meet you, Steve. The team you've given us is a spectacular team. Over to you.
Great, thank you so much, and always a pleasure to be able to present to you. I'll be on the brief side, knowing the length of your agenda today, but happy to answer questions as well. I'm going to start with what I thought was a great quote that's been communicated this year from Vladimir Lenin, of all people. There are decades when nothing happens, and there are weeks when decades happen. And it feels like this last week has been a decade in many different ways. And who knows when this decade will finish. From a capital market perspective, what I want to highlight as we stand here today is that for the most part, the global equity markets are continuing to price in a negotiated resolution to the Ukraine war. And as we stand here, equity markets are down 8% on the year, which may seem like a lot because we're not used to volatility in these markets in the US that seem to always go up. But the markets were down nearly 8% before the Ukraine war started. Arguably the bigger risk that has caused stock prices to decline this year has been the surprising, to the Federal Reserve anyway, persistence of inflation in the economy and the quick turn in Fed communication to higher interest rates this year. Because the volatility has been largely a function of rising interest rate expectations here in the US and Europe, not only are equity markets down about 8% on the year, but bond markets are down too, which normally isn't the case. The broad bond market so far this year is down close to 4% on the year. What's up? The commodity complex is up about 25%. That's largely a function of the war and sanctions. And while there's a lot of volatility in the markets right now, I would summarize market activity, at least outside of Russia, as being fairly normal in the sense that liquidity exists, markets are clearing. So far, anyway, no signs of systemic concerns. Inside of Russia, of course, it's a very different story. The Russian stock market is closed. Russian assets, for all intents and purposes, are untradeable. What I want to leave you with is three, and I'm sure there's more than three, but at least three potential new risks that have been awoken by not the war per se, but the West's response to the war, as these might be longer-term risks worth pondering and thinking about as long-term investors. The first risk I highlight is a function of the United States freezing the central bank assets of Russia. This was a very severe part of the sanctions that were rolled out, and essentially means that Russia does not have access to its U.S. Treasury bonds that it maintains on its balance sheet of its central bank. For Russia in particular, this is not a huge risk because Russia has done, in retrospect, a clever job of reducing significantly its reliance on U.S. Treasury bonds on its balance sheet over the last 10 years. However, the great risk and unknown is now that other countries know the U.S. is willing to freeze central bank reserves to encourage countries to comply with its policies. Do other countries like China decide to invest their reserves differently? So that's one risk that the markets are going to be looking at quite closely. The second risk is the sanctions. Obviously, the size, momentum of the sanctions from the West surprised Russia. That's clear. I would argue that the size of the sanctions also surprised the West. Sanctions hurt both sides to some extent, and the political momentum towards ever more sanctions towards Russia, which continues to this day, has been surprisingly strong. Again, in the context of that, one has to consider whether other countries now pull back on globalization and trade, knowing that sanctions in the world going forward might be more severe and more easily put in place than they have been in the past. And then the final risk I highlight is arguably the biggest risk for the markets in the near term, and that's testing the Federal Reserve put. For the last 20 years, I'll say, maybe more than that, the stock market in the US has operated under the general consensus that if market volatility were to get too severe, if recessionary fears were to become significant, the Federal Reserve would step in to drastically lower interest rates, both on the short and long end of the curve, which has the expressed intent of elevating equity prices. It's what's been called the Fed put, and it's been very helpful for stock investors for the last several decades. The reason the Fed has been able to step in every time there's economic weakness, or one of the reasons, has been we have not been facing inflation since the 1970s. We're now in a situation where clearly the economy has inflationary risk, it has real inflation. And the Federal Reserve's mandate is to ensure price stability and employment in the economy. Because the Fed has not had to worry about price stability, the market isn't quite sure how it weighs the priority of those two objectives. And so far, it hasn't had to, because the US economy has continued to rebound and grow reasonably well from the pandemic. So the Fed's communication that it would increase interest rates this year comes in the face of strong economic growth. And most would appreciate that the Fed is prioritizing controlling inflation over economic growth because the private sector is already growing quite a bit. The big question is, what if the sanctions and the war in the Ukraine suppress demand sufficiently that recessionary risks become more significant? Will the Fed continue to raise rates to suppress inflation, or will it pull back and lower rates to support the markets and the economy? And that might be a risk that we experience more in the near term. So with that, I'll conclude by saying this year has been a whole lot more volatile than last year. Two big risks to the markets have been the war in Ukraine and the expected higher interest rates here in the US. And I will close it there and happy to take any questions that anyone has.
Thanks, Steve. That was actually really helpful. It kind of reminds you of the ancient times where they used to lay siege to a castle, and that was a surprisingly effective move, not involving slaughtering people. It sounds like what is old is new again. Floor's open. Anybody have any questions for Steve? Jump in. No, we're usually not this quiet. Peru, over to you.
All right, great. Thank you, Steve, for your comments. Now, Mr. Chairman, I'm actually going to share with the board some specific impacts to our portfolio, which I'm sure is of interest to all of you. So what is our exposure to Russia and Ukraine? And so I'm going to give some numbers. And of course, we have my colleagues, Jay and Christina, on standby if we need to drill down deeper into these exposures. So firstly, on the fixed income side, we have, in absolute terms, about $3.7 million in Russian and Ukrainian debt. So a really small number, and that comes through some of our emerging debt managers. And on the equity side, our total exposure is about $9.5 million. So put together, totally, our plan is about $5 billion, and we have a very, very small exposure to Russia and Ukraine, which is $14 million. So in basis points terms, it actually comes to only about 25 or 26 basis points for the entire portfolio. And in fact, it's hard to market these assets given that they're not trading now, but I suspect that our exposure is a lot lower now, given that they've probably lost a lot of value. As you all know, yesterday MSCI basically pulled Russia from its indices, and MSCI is one of the largest index providers in the world. And not just MSCI, FTSE Russell did the same, citing Russia as uninvestable. And the Russian central bank also suspended trading and stock operations. Now, our exposures, as all of you know, we don't directly invest in securities of these countries. We actually get exposure through our managers. And so on the equity side, about 10 or 15% of our exposure is actually through passive holdings. So we are invested, for example, in the emerging markets equity index, and that has a very small weighting for in Russia. Now, the good news for us is we are actually underweight even the small weighting that Russia has. By the way, Ukraine has 0 weighting in the indices, and Russia has a 3% weighting in the emerging markets index and a 0.36% weighting in the all country world index. So it's very, very small in terms of its exposure in global indices. And we are actually underweight even that small number. So for example, while the benchmark has 33 basis points of equity, 36 basis points of equity, our portfolio only has 20 basis points exposure. So to that extent, we will actually outperform our benchmarks, if these securities lose value. And the exposure to these securities comes, we've actually drilled down and looked at the underlying managers, and they come from few different managers to cite two. There's GQG and Wellington. These are high conviction managers, and these are managers who manage emerging markets assets for us. And also to remind the board, these are in commingled funds. So these are not separate accounts where we can actually go and divest out of these securities, even if we can. So there are other investors along with us in these funds. So that's something to keep in mind as well. So I think the highlights are that the index exposure of Russia and Ukraine is pretty minimal. And even for those minimal exposures, we are underweight the benchmarks. And right now we cannot trade these securities. We have exposure to these securities through high quality managers. So we are looking and we are monitoring the situation. We are in touch with our managers. So that's the update on Russia and Ukraine. I'm happy to take any questions before we move on to other agenda items. I do want to share performance information after this as well.
Questions?
Floor is still open. Anybody want to talk about the issue in Ukraine?
Yeah, I have a couple of questions. Thank you, Prabhu, for the update. So, do you know what our managers are doing with respect to the Russia exposure?
Yeah, I'm actually going to turn this over to Christina to answer this, Trustee Menon, but I do know that our emerging markets managers have been paring down their positions for some time now. But to give a more informed response to that, I'll turn this over to Christina.
Thanks, Prabhu. Thanks, Trustee Menon, for the question. Yeah, a lot of our emerging markets managers, they have actually taken down their Russian exposure since this year. Some emerging markets managers actually have a very high weight in Russia in last year, given the high growth they have observed. However, given the tension this year, they have meaningfully taken that down. And going forward, as Stephen and Russia and Prabhu has mentioned, there is essentially no liquidity. We cannot sell off these positions yet, but they will closely monitor the situation. And when the market becomes open, I think they will take actions.
Okay, yeah, I agree. And I think some of them now are trading basically as cheap options, I think, in terms of where the pricing were compared to before it started. Related question, do you know if they have, given that the Russian market itself is closed, do you know if any of the managers have local exposure? And if they do, how are they pricing those securities, given that they're not trading right now?
Yeah, so some managers do have local shares like GQG, and they are not tradable. So they are essentially not putting any, they have an intrinsic value model, which has a 90% discount to the current, to the price prior to the close. So very deeply discounted. And also it's a very small weight to the portfolio. So the impact to our overall portfolio would be small. However, again, these stocks are essentially valueless in their model. So.
Okay, so that's good to know. Okay, thank you, Christina.
Sure.
Any other questions for Prabhu or Christina?
I have a question, and thank you, Stephen, as well, for the very nice review. I know he's probably dropped, but if Laura can pass on compliments, I appreciate it. I guess the question I had was with sort of political guidance from the governor around divesting other for CalPERS and CalSTRS. Does that have any impact on us? Do we have any direct holdings?
I'm assuming that question is directed to Harvey.
Yeah, I guess I don't know.
Sorry, I thought the question was, do we have any direct holdings?
Right. Do we have any direct holdings to Russia? Because I think that's what the guidance was, to divest. I understand a manager.
Yeah, we invest through the managers, even for passive funds. So yeah, we don't have direct holdings.
Yeah, at this point, it is not, although the trading is frozen in these securities, it is not unlawful under US law or California law to have them in the portfolio. So at this point, we're not affected by anything that would ban us. You know, the federal government has not gotten to the same point it got with the Iranian sanctions a dozen years ago, where it actually banned the holding of these securities. So we're not at that point yet.
Thanks, Harvey, and thanks, Christina. Yeah, that answered my question.
Floor's still open. Anybody else want to jump in? Anybody? Staff, public? Back to you, Peru.
Thanks, Trustee Sunita. Sorry, I misunderstood your question. Yes, we don't have any direct holdings in any securities, and that's true of not just Russia, for all our holdings. We do invest through our managers. I did want to share some performance information, as I always do. These are, again, pro forma numbers. These are unaudited numbers, and these are merely estimates. They come from our investment consultant, Makita. Through March 1st, fiscal year to date, our pension plan is up about 1%, actually 98 basis points to be precise. And the healthcare trust is down 1.6%. And to put this in perspective, quarter to date, so just from January 1st to, this is through the end of trading on March 1st, the pension plan was down 4.06%, and healthcare was down 4.24%. So all these losses have come this quarter. So this quarter, as Stephen mentioned before, has been tough. The S&P is actually down 9% year to date. And so roughly, we are down about 45% of that, given our exposure to various asset classes. With that, Mr. Chairman, unless there are further questions, I'm going to invite Casey Boyer of Newberger Berman to present the private equity report, item 2B.
Hi, Casey. Nice to see you again. Over to you.
Hi. Thanks for having me again. Give me a minute and I will share my screen. I think everyone can see. Perfect. So today I'm going to present Q3 numbers for the plan, and I'll just touch base as well on Russia-Ukraine exposure. We've been through our portfolio, obviously across our platform and specifically within San Jose's program, and do not currently have any exposure in Russia or Ukraine. We don't have any companies headquartered in the area. We're still looking into, we obviously have hundreds of portfolio companies within our portfolio. So we still have not found one that even kind of has any locations or anything in that area. So just wanted you all to be aware of that within your private equity partnership with Newberger. If we look to page 2 here on the screen, again, just an overview of the entire private equity portfolio for police and fire. You'll see the legacy investments, Newberger in the middle, and then the combined performance. All programs doing very well. We saw a nice uptick in Q3 for the program. It's actually, over the last 2 years, we've seen quarter increases. This quarter, Q3, was actually the largest increase we've seen. The net multiple for Q2 was 1.72. The net multiple here you will see is 1.84. So a good uptick in value and distributions. The total distributions we've given back to the program is 21.7 as of Q3. During Q4, another 12 million was distributed back. So still continuing to see exits and realizations within the portfolio that we're able to distribute back to the plan. Turning to the next few pages, again, there's a handful of pages here that are benchmarking each underlying fund investment within the program. And you'll notice for Q3, we actually added this column here in the middle, contributions. So it is intended to give you an idea of how invested each of those funds are. So if we turn to where the Newberger investments start, it will give you more of an idea of how far along in the development each fund is. So you'll see, you know, investment 56, which is still investing, and we definitely definitely expect the performance here to turn around, but they are only, you know, just under 50% invested, so they still have quite a bit of investments to make. And so this number was added to, I know there are questions last quarter and maybe previous quarters about where in the life cycle these funds are. So continued good performance at an underlying level, and expect that to continue. I will move on to page 8, which gives additional information on where exposures lie within your portfolio, both on a committed and invested basis. So you'll see we actually added some more information on this page too, compared to last quarter. At the very bottom, you'll see 3 pie charts, all of these on vintage year diversification within your portfolio. So it should give you a good idea of when capital has been committed in each year and how that capital is actually being put to work in terms of when it's being invested into an actual portfolio company. And then you'll see, obviously, the combined basis. We are more heavily weighted towards North America, Europe, and rest of world continue to be a part of the portfolio, but still heavily weighted towards North America. On page 9, overall performance analysis for the program. On the top, you'll see attribution by investment type, so how primaries, co-investments, and secondaries are performing. Each one performing very well, and you'll see kind of both how they're doing on an overall basis for gross TVPI, and then DPI is distributions to paid-in capital, so how much has been actually distributed of those investments. Secondaries always has that higher distribution, as they are investments that are more mature when we go into them. Co-investments tend to develop quicker than primaries as the capital goes into the ground faster. So we've been happy and with the performance of each investment type, and each one is doing the intended part of the portfolio. At the bottom, you will see the benchmarking for the Newberger strategic partnership. As I mentioned, the net TVPI for the quarter was 1.84, and the net IRR 38.3. Both of those metrics squarely above first quartile for Q3. So happy with that first quartile performance. The next couple pages are a deep dive into the portfolio and each underlying investment. Won't go into that in detail, but I'm happy to answer any questions that you may have.
Thanks, Casey. I'll note Casey's you got 4 in a row here, Casey. So Floor is generally open. Feel free. I know Casey's pretty good on her feet. Feel free to interrupt in the middle of her thing, but floor is open. Any questions for Casey at this point?
Yeah, Casey, so thank you for the presentation, and looks like portfolio has done really well. I want to ask you, two parts to this question. One is, if you broadly look at the Newberger exposure between, if you were to say growth versus value, what would that be? And the second part is that in the public markets, the growth segment, if you exclude kind of the large mega caps, they've gone through a really very deep correction, right? I mean, substantial, in many cases, 50, 60, 70%. Do you think that will impact the valuation of what we hold as we go forward the next couple of quarters?
Yeah, so I don't know that I could give you a percentage off the top of my head without it being wrong on kind of what the difference is between growth and value, although within this portfolio, we've definitely focused more on buyout, and whether that's, small, more value type buyout or larger cap buyout, that's been our primary focus since around the second year of the program. So in terms of historically and kind of what we see going forward, there's value in, for us, very much how we diversify within buyout. So we're very cautious of where we are finding value and deep value buyout within a portfolio, and also maintaining that mature, more large cap exposure. When we look at performance within, whether it's mid cap, large cap, it's actually very similar in terms of what the historically first quartile performers have been within a smaller buyout and a larger buyout. That's actually changed over time. If you were to look at those same numbers in the 2011, 2010 timeframe, there was more of a upside within the smaller mid-cap sector. We've seen that diverge a little bit over the last 10 years, where large cap has been, large cap and mid-cap first quartile fund performers have been closer to the same. And then within large cap, you'll see between top quartile and kind of fourth quartile funds, it's a smaller range of performance. So we try to be very focused on that aspect of the market and making sure we have appropriate inclusions for kind of both ends of the market.
Okay, thank you, Casey.
Floor is still open. Any other questions?
Yeah, hi Casey, this is Howard. Thank you for your presentation. I thought it was, as usual, very, very good. I had a couple of quick questions. One, on the DPI, on this one, is it possible to get benchmarks? Because, like, for example, that secondaries one's pretty high, 0.93. Would like to know, how are we doing? I don't know if that's, hopefully it's possible with Cambridge. And the other two questions, I noticed on the slide 3, for example, when you show the legacy, sometimes the contributions are larger than the commitment. Is that because the commitment's not including fees?
So, yeah, there could be a number of reasons. I'm looking to see. Yeah, so sometimes it's because the fund might have the ability to charge fees and expenses above the commitment, and that's very specific to that certain fund legal terms. And sometimes they have the ability to recycle capital. If they've realized an investment in a short amount of time, they may have the ability to take that capital and reinvest if it's within their investment period.
Okay, all right, great. And one last little thing on the slide 2, I noticed is the what is it? The distribution and the commitment are exactly the same in NB.
That happens to be true. The remaining amount we have to commit at the end of that quarter happens to be the same of distributions. Unusual, but that's how it worked out.
Okay, it's amazing. All right, great. Well, thank you.
Yes.
Well, Casey, have we invented perpetual motion? Am I missing something here? Anyway, any other questions for Casey? Do you want to? Are you doing all 4 of these, Casey? No, wait, this is Makita. So, hey, over to you, Prabhu. I don't know where the heck we are.
Thank you, Mr. Chairman. Thank you, Casey. I'm going to pick the baton from Casey and pass it over to Laura Weirick.
And actually, Jared Pratt is going to talk about private markets, and then I'll roll into the public reports.
Thanks, Laura. Okay. Back up here. Yeah, so here we have, everybody. Here we have the public version of private markets report. We provide a more detailed version to staff besides this report. So to go to this fairly quickly, here we have the snapshot page. It's a summary of each account type, and we'll just focus on the far 2 right columns, which have your IRR compared to a public market equivalent. You can see in general that as you go down each row, the comparison for the pension is quite favorable with a great overall IRR of almost 11%. I'd also note venture capital, that return is technically true. We typically show it as not meaningful, and we should have this time. So I don't think staff wants to be held to a 93% return expectation. But just something to note that number is actually not meaningful, impressive as it is. I'll go through here on page 3 just to highlight this page through each asset class for the sake of time. So this program is a decade old. It's mature in the sense of contributing nearly everything that's been committed, which you can see on the bottom left part of the table. Performance for this group of assets isn't quite as impressive as the others in an absolute sense. This is the only one with a single-digit return number, but nonetheless, it is on par with the public market equivalent, and more recent investments by staff have done quite well. And please stop me if you want to stop at any page within each asset class. I was just going to cover this summary page of each one. On page 8, with real assets, we're up to almost half of the target. A solid IRR here of almost 14%, handily beating the public market equivalent return of 9.9%. Going to page 13 for real estate, we're slightly overweight target here at 3.5% actual weight versus a 3% target, as real estate has done quite well recently and run up on a relative basis inside the portfolio. Again, a near 14% IRR that you can see right. The public market equivalent return here is 8.4%, so very nice outperformance over a public alternative. And then finally on page 18 is venture capital. So as mentioned, this is a new program. There's 5 investments so far. Performance is shown as not meaningful on this page. So again, there's a 3% target here, and we're ramping up not quite half of 1% weight so far. So that was the very fast version, and I'll stop there to see if anybody has any questions.
Any questions?
Yeah, I do. Hi, Jared. Thank you for the presentation. Very swift. Just a couple little ones. On I guess slide 21, you had to use Preqin instead of Cambridge. Is that something that's meaningful in terms of differences in benchmarks?
I can actually take that question. So Cambridge has sold their benchmarking business to IHS Markit. And IHS Markit has renegotiated all of the contracts with all of the folks that get information. So as we evaluate whether or not it makes sense to move forward with Cambridge or other providers, we're using Preqin for now, which is relatively close over long time periods.
Okay, all right, great. And then also with PE, I think it was slide 26. Does the PE include mid cap buyout, or is it only or is all the buyout, whether it's mid cap, large cap, are they all in buyout? I guess what I'm really asking is where's the small to mid cap buyout if in terms of our exposure? What category would it be in?
It should be in buyout. We can get more information on the specifics of how that breaks down.
Okay, yeah, because in light of the Morgan Stanley report last week that we heard during the IC, they were talking about leaning more towards opportunities with small to mid cap because there's more dry powder. Anyway, that was the reason I brought it up. All right, great. Well, thank you.
Floor's still open. Anyone else want to jump in? All right, back to you, Peru.
All right, thank you, Mr. Chairman, and Laura, back to you for 2D.
Okay, thank you very much. So the performance report for the pension plan through the end of the year, numbers were quite strong. If you recall, back not too long ago, on December 31, we had the S&P up over 10% for the fourth quarter, and other asset classes like real estate investment trusts and whatnot doing quite well as well. Just to summarize, if we take a look at page 24, you can see that the asset value of the retirement plan stood at over $5 billion as of the end of December. And that was an increase of about $142 million from the prior quarter. Even given almost 50 million in outflows, there were almost 200 million in investment gains in the retirement plan during the fourth quarter of 2021. And you can see that the allocations are quite close to policy allocations. And we're going to talk about those policy allocations during our strategic asset allocation discussion very shortly. Taking a look at page 25, you can see performance for the retirement plan. The fourth quarter up 4.1%, well ahead of a 60-40 benchmark and the liability benchmark portfolio. If you take a look at the one-year number, which is always nice to do for a full calendar year, you see the return of 14.6%, very slightly behind the policy benchmark, but you see it outperforming all of the other benchmarks here, ranked above median for the quarter and right around median for the one-year period. You can see the underlying asset classes here, again, quite strong positive returns for equities. On the next slide, you can see private markets. Private markets, especially for the one-year period, up 35.4%. So a really strong return for private markets. When you exclude the Russell 3000, which, as you know, is sort of a placeholder for uncalled commitments, you get an even higher return of 38.3%. So really strong returns across all private markets asset classes recently. Taking a look at page 27, you can see that bonds, while it was not a strong bond market for investment grade bonds, you have a lot of diversification in terms of high yield and emerging market debt, which was positive for the portfolio. And then within the low beta asset class, market neutral strategies, relative value strategies up 12.7%. So strong returns from hedge funds as well. And then on page 28, you can see returns for other asset classes in the portfolio. TIPS had a good quarter, as you might expect, with an inflation sort of spiking environment, and core real estate up almost 13%. So I won't go into individual managers in the interest of time, but suffice it to say that manager performance was strong, rolling up to those strong benchmark returns. And then one thing I'll point out in the materials is that towards the back, we have more sort of risk-adjusted metrics. If we look at the portfolio, say on page 53, for the total fund for the one-year period, you can see that standard deviation or risk was just around sort of the median in that second box there. for risk, and Sharpe ratio at 2.7%, also right around median for the risk-adjusted return. So I think that's sort of informative as we move into the strategic asset allocation discussion, that that risk levels currently look pretty close to peers. And I'll take any questions on the pension report, or can move on to healthcare.
Floor's open. Anything for anybody? Back to you, Laura.
Okay, thank you. So moving over to the healthcare report. The value of the healthcare trust assets was 283.4 million, up 8.4 million from the end of the prior quarter. And there were net cash outflows of about 2 million, but investment gains of over 10 million for the 3-month period. And you can see here that current allocations are close to policies. If a new asset allocation is adopted for the pension, for the retirement plan, we'd recommend revising these allocations as well to make sure that strategically the two plans are aligned. On page 23, you can see the performance update here, a return of 3.8% for the healthcare trust for the quarter and 10.8% for the 1 year. So while these numbers are lower than those of the retirement plan, they did rank very highly within the peer group in the top quartile, 17th and 21st percentile. That's because the healthcare trust universe tends to be more conservatively invested. There's more bonds that didn't do as well. And so this healthcare trust being invested a little bit strategically, more similar to your pension plan and having more equities in the portfolio was a very strong place, this fund very strong in the peer group. In terms of individual asset classes and managers, I will not go into detail given that you do have the same strategic allocation and also the same liquid managers as you do in the pension. So happy to take any questions on healthcare performance as well.
Thanks, Laura. Floor's open. Any questions for Laura?
I had a quick question on the retirement plan. It's actually more conceptual questions. You don't have to go back to the deck. So you said that the allocated but uninvested amount for privates sits in Russell 3000. Is that what I understood? So this is what we have strategically allocated minus whatever has been deployed, including drawdowns.
Yes, so historically, there were some major mismatches between sort of the policy allocation and how the fund was actually invested, given that it takes some time to get to the policy allocation. And so the board would adopt a strategic asset allocation that had a certain amount of risk in it and certain risk level given the private markets allocations. And then, a lot of it would sit in cash or bonds or other asset classes. And so it wasn't being expressed, the board's wishes in terms of the asset allocation. So then there was a strategic shift, a couple of years ago, probably about 3 or 4 years ago, to put some of the unallocated funds for private equity into Russell 3000 instead of just, bonds or cash for the rest of the portfolio.
Okay. And so that I see the number at 147 million. So when we look at the strategic asset allocation discussion, so that will be included in the current exposure of private equity or private markets?
That's right.
Is there more dry powder that we have? You said some of it is in Russell 3000. So.
Yes, there's always going to be, and everyone does this differently. There's always going to be areas that you can pull from the rest of the portfolio. But we, as your investment team internally and Makita does pacing studies where we make predictions about how much the funds will distribute that can then go back into the fund and how much they will call. But you never know exactly for sure, when those calls will come or when those distributions will come.
Sure. Besides that caveat, that's sort of the number we have uninvested at this point. Undeployed, I should say.
At this point, yes.
Okay, thank you. I appreciate that.
Mm-hmm.
Floor's still open. Any other questions? If not, let's do it this way, Prabhu. Let me turn over you for any summing comments on what we've already looked at. Then let me let Eshfar lead on the asset allocation, then we'll turn it back to you. Does that make sense, Prabhu? So any summing comments on what we just heard, Prabhu?
On the performance, Mr. Chairman,
Yeah.
I mean, nothing significant. I think the more important thing for the board was the Russia-Ukraine exposure, and as we pointed out, it's pretty minimal. And again, these reports are dated, so they're from last year, last quarter, and the market has taken a hit since then, and so the numbers have come down, which we will discuss at a future meeting.
Great, thanks. Then we're on to item 4F, was the asset allocation. Ashfar, do you want to make any remarks? I know we covered this in the investment committee. Go ahead, Ashfar, over to you.
Yeah, thank you, Drew. So, as the board knows, we do the strategic asset allocation once a year. It's an important role for both the board and the IC. And this year, like in others, we looked at the current, our current asset allocation, and we tried to see if we could make some tweaks, try to make it better. And in that regard, Prabhu and his team, Makita and Veris, ran a number of scenarios for us. We discussed these at the last IC meeting a couple of weeks ago. And then based on that, we decided to, try, I think, one or two more kind of models. And we're going to present those. With that, I'll hand it over to Prabhu.
Yes, thank you, Trustee Menon. So I'll make some preliminary remarks and then turn this over to Laura, who will actually make the presentation. So this is an annual exercise, as the IC chair informed the board. It is strategic asset allocation, so it is meant to be longer term. And one option before the board this morning is not to make any changes. But markets do change, capital market expectations change. And so more often than not, in light of new information, we sometimes tweak our asset allocation. Once in a while, of course, you have an event like March 2020, which forces us to make wholesale changes. But we've not had that kind of a drawdown at this year so far. And having said that, so as Trustee Menon pointed out, we did offer 3 options at the IC, and we've added a 4th option, which Laura will actually talk about, which was not presented at the IC. But I would urge the board to focus not so much on the mixes, it's certainly the board's prerogative to choose whatever mix you want, but to focus on the risk level, right? So it's fine. It's the risk level that's the single most important decision that a board can make in terms of risk and return going forward. And actually Laura and both Makita and Veris will talk about the risk number. So the options presented, you'll see, are pretty close to the current risk level, which we thought was appropriate, but we are certainly open to discussion on that. And we did offer a higher risk option as well. So we will get into all of this, and we can discuss all of these options later. But for now, I'm going to turn this over to Laura.
Thank you. So we have the strategic asset allocation document on your agenda. And just to sort of review, what we do annually, Makita Investment Group puts together updated capital market expectations for expected returns for each asset class. The investment committee heard from our director of research, Frank Benham, who has engineered that process over a couple of decades now. And Makita has, we don't manage money. We are purely an independent advisor. So it's an academic process that isn't influenced by where we would like to steer your money in any way. And each year we put together those expectations. And in the past, many years since the global financial crisis, expectations for asset class returns have generally been going down for the future, mainly because we've had such strong returns that at some point we see very high valuations, and we'd expect them to mean revert somewhat. However, interest rates play a major part in our expectations as well, and they're a building block of the expectations. And so interest rates going up this past year actually meant that our expectations for individual asset class returns increased slightly. So it's a nice change from the past several years, and we keep saying we think the future returns are going to be a lot lower than they were in the past. As you know, your actuarial assumed rate of return of 6.625 what we're targeting. And the good news is that your current asset allocation is expected to exceed that. And then also in your investment policy statement, you have a risk level target of remaining below 12%, according to Veris's risk calculations, and the current asset allocation does remain there as well. So there's no need to make a change this year, but of course we always want to look at new asset allocations for your evaluation, given changing market environments. So in this particular document, and we are not going to go through every slide, we did discuss it in detail at the investment committee. We look at your current allocation, compare it to a few others, and then also look at a 60-40 equity bond allocation, just as sort of a shorthand for a diversified portfolio. I will highlight the slide with our bar chart here. Basically, the message here being that it's harder, your job is harder than it used to be. You know, back in the 80s and 90s, you could have invested 100% in bonds, you know, even the year 2000. And had a return expectation over your assumed rate of return. But now investors need to take more risk in order to reach that return to pay your benefits over time. So our analysis takes into account mean variance optimization, which is based on those expectations that we come up with. But we know that our numbers aren't going to be exactly right, you know, given our lack of a crystal ball. So we do look at other sorts of analysis as well, like historical scenario analysis and stress testing and that sort of thing. The main page here and main chart is on page 6. This eye chart here. That shows you the current allocation in the left column. And then we have mixes A, B, C, and D. The investment committee discussed mixes A, B, and what is now D, and asked us to go back to the drawing board a little bit and do one more mix as well. So that's what you see as mix C. So if you look down at the bottom in the darker gray box, that's where it's sort of the outcome of these allocations rests. At the top, just in terms of pointing out a few of the differences between these allocations, mixes A and C, you can see have a lower emerging market equity weight. That's something that's been a topic of discussion in the past. Mixes A and C also have lower public equity allocations. You can see in mix A, US equity would go down by 3% in addition to the 2% from emerging. In mix C, US equity would go down 1%. Developed markets equity down 1%, and then emerging markets equity down 2%. In those mixes where public equity is going down, generally private markets is going up. You can see buyouts in mixes A and C going from 7 to 9%. And you can see that all of the alternatives here have a higher venture capital weight by 1%. Also within private debt, mixes A and C and D would go up 1%, mix B would go up 2%. So we have some additional private markets exposure in these mixes as well. Mix B does not have any exposure in high yield bonds. That was shifted to private debt, taking advantage of private markets. And then mix B and C no longer have commodities exposure. That was shifted to other areas like private real assets in mix C. You also see a big difference in mix C in terms of cash equivalents or immunized cash flows. So essentially T-bills or cash, you know that you have 5% in sort of these immunized cash flows to make sure that you can pay benefits over the next 5 years, even if there's a giant drawdown in the markets. But mix C would take that allocation up quite a bit. You'd have dry powder if we were to have a major drawdown, and also bonds, investment grade bonds, look a bit less attractive in a rising interest rate environment. So perhaps holding some of those bond funds, you can see in mix C, bonds would go from 11% to 4.5%. Long-term government bonds would go from 3 to 1.5. As a reminder, long-term government bonds are not a duration play. You're not holding them because we think interest rates are going down, which is an environment that long-term bonds typically do well. You generally hold long-term government bonds as a hedge against things like major geopolitical risk, like we're seeing right now. If we look at major market stress periods in the past, long-term government bonds are typically the only positive returning asset class when everything else is down. But that said, it also isn't the best interest rate environment right now for long-term government bonds. So mix C would take them down. So looking at the dark gray on the bottom, we can look at the Makita expected returns over 10 and 20 years. These are the average annual returns that we'd expect. So you'd expect about half the time to be above these numbers and half the time to be below, and they'd average out to what you see here over the 10 or 20-year period. So you can see that looking at the 20-year return, all of these allocations, with the exception of a 60-40 portfolio, would have an expected return above what you're trying to target actuarially. Mix B and D would be the highest at 7.1 and 7.2 returns. The mixes A and B would have higher expected returns by a bit as well relative to your current allocation. Looking at the Veris standard deviation, mix A would have a lower standard deviation than where you are now. Mix C would be slightly higher, mix B a bit higher than that, and mix D being the highest. And so all of these still fall below that 12% risk target level that you have in your investment policy statement. We've also looked at the split between growth and income and diversification, which is something that we look at as sort of a shorthand. You don't have by any means 70% in public equities, but have 70% currently in more equity-like risk, and 30% in more income and diversification. And of course, these allocations are subjective, but mix A would keep that split the same. Mix C would increase slightly. The growth assets, mix B would do so more so, and D being the riskiest. In terms of illiquid assets, you can see that all of these alternative allocations have a higher illiquid asset level. When we look at the funds that have done incredibly well in the very recent market environment, you do see a lot more private markets, especially venture capital. Not to say that we should be chasing returns, but we do think that there's some persistence there with the fact that that private markets are less volatile and not everyone can invest in them, which can be a good thing. Because of those higher private markets allocations, fees would be higher as well. And we're looking at these returns on a net of fees basis, but we just want to point that out because we know that's been a sensitivity historically. So that is the overall comparison here. If we look a couple slides ahead, I'll just point out what your peers look like, since that is something that we think about. You can see, you know, these numbers are self-reported. Take them with a grain of salt, especially when you get into some of the smaller asset classes like hedge funds. You know, people might classify things differently there. But I will look at the median allocation to total equity for your peer group is 48%. Right now, you have 46%. These alternative allocations would stay around that range. So looking at your total equity allocation, it sort of is similar on that front as peers within your peer universe. Moving ahead to the next slide, we do look at downside risk. Your risk of loss over a very long time period is generally nil, but in the short term, if you look at a one-year period, you can see a worst-case scenario return around 19 or 20% down. Not a huge difference between these different allocations. And then the probability of experiencing negative returns, about less than 1 in 3 in any given year, and it goes down for longer time periods. And then the probability of achieving your actuarial rate of return target. You can see here that, as expected, the riskier asset allocations with the higher expected returns would have a higher probability of achieving your actuarial rate of return. Jared will just spend 2 minutes on the other analysis that we do here, and then we can get to our discussion portion, or perhaps Veris as well.
Thanks, Laura. Yeah, so on this page, we can look at risk in different ways, as Laura just highlighted a couple, but different ways than just standard deviation. So this is looking at historical shocks. It's looking at the exposures of each mix. How did those exposures actually do in these real historical, and how would each mix have done had it been invested like this at the time? And overall, you know, as probably mentioned, there aren't that big of a difference as from a risk standpoint across these mixes, and so not surprisingly, there aren't that big of differences here either. Just an overarching theme would that be, you know, each time that equity markets in particular got hit pretty hard, that's where these would see the biggest drawdowns. So probably no surprise there, and not a huge difference from mix to mix. On the flip side, we can look at historical scenarios that would have been done well. And again, when equity markets have had big rallies, that's when each of these mixes would have done especially well. And you'll see that we had a COVID drawdown on the last page going down. We can't put a final date on the endpoint of coming back up yet. So that's why there's not a COVID scenario on the upside quite yet. Another way to look at it is basically shocking these portfolios. So we look at where are rates now, where are valuations now, and if these scenarios happened, high magnitude situations happened, and we shocked the portfolios in these situations, what would happen? And probably not surprisingly, again, when credit spreads really blow out, or when equity markets decline quite a bit, that's where you see the biggest movements. Flip side, things that would boost the portfolios quite a bit is when those things reverse. So you see on the bottom, when equity markets really go up, that's where you see a big boost to the portfolio. And then one final way to look at risk is from an even higher level than that, is just looking at factors and when the market gets surprises. So we look at 4 different surprises. As you know, expectations are always being priced in. It's the surprises when the market moves dramatically. And so we're looking at surprises across interest rates, inflation, growth, and systemic risk. And again, not a huge difference from mix to mix, but the 2 things that would move the portfolios the most are shocks to GDP growth or shocks to systemic risk. Those are also, as the last bullet point points out, the risks that you're most highly compensated for, which is why you invest in them in the first place. So, a few different ways to look at risks, and because each mix isn't making a dramatic change to the overall risk, there's not huge differences when comparing across the mixes. So with that, I'll turn it back to Laura.
To summarize, we think these are some good options. However, we don't think there's any reason that you need to make a change to your current policy. But perhaps we should go back to the comparison, or probably would you like to switch gears for a minute?
Yeah, thank you, Laura. Mr. Chairman, at this point, before we actually get to discuss the options, I think we should also hear from Veris.
Oh, great. Say Eileen. Yeah, over to you, Eileen.
Thank you very much, Mr. Chair, and good morning, everyone. And probably, I don't know what time to say good good evening, I suppose, to you. I'm going to share my screen. Bear with me. And can everyone see my screen?
Now.
Great. So I'm going to just summarize a couple comments and to maybe parrot what you've heard a little bit from Laura and Jared, in that we did evaluate the various portfolio mixes based upon our factor-based risk models, and we concur that all the mixes that we evaluated would fall below the board volatility limit for the total fund of 12% as stated in the IPS. All of the mixes do demonstrate similar levels of equity market sensitivity as measured by beta. So the movement of the fund in terms of how closely it moves in tandem, if you will, with the equity markets. We also looked at the contribution to risk from the major factor drivers, risk factor drivers of capital market results. We'll take a brief look at those. And we do recognize that rates are a significant driver of capital market results as well. And you'll see that duration risk is not a meaningful risk exposure in any of the mixes being evaluated or considered. We did introduce at Veris inflation scenarios because you and other clients of ours have been very focused and concerned in terms of what this higher inflationary environment might translate to in terms of actual capital market results. So focusing on this next slide, slide 3, here we have our risk calculation for each of the mixes under consideration. And one thing I'll comment on this page is, if you recall, in Laura's review of the quarterly investment performance report, she compared the standard deviation or risk of the total portfolio, and that's risk as measured by standard deviation, which is simply the volatility of returns. And you saw a level of roughly 5%, and that was also in line with peers, right? Also 5%. Well, you look at this slide, and we're really forecasting twice as much risk, or there is twice as much risk evidenced in these portfolio structures based upon that factor model that we use, which is kind of extrapolating trends in correlations and volatility over the most recent roughly 8-year period forward. And that's important to you all, because you want to ensure that you are accurately capturing the risk exposures, not based upon where the markets have been, but where they are likely to go, particularly based upon short and nearer term risks. And so that's what you're seeing on slide 3. And it was commented earlier, the results are very similar. The most distinctive mix is really mix C, and I would call that, or characterize that mix as a barbelled risk structure, in that it's got a slightly higher growth exposure, kind of reduced public markets, higher private markets, but that's the one where we've eliminated commodities and have that meaningful increase in that immunized cash flow component. So that's what I mean by kind of a barbelled risk posture, because you're taking more of that risk off the table by immunizing more of those cash flows, but then kind of adding more on the back end. And you can see that that really results in a very similar risk profile. None of these would exceed the 12% limit. And then I just sort of compare those to that 60-40 mix, which is meaningfully lower, but obviously as a result of having the very high exposure to fixed income, which is the most effective risk mitigating asset that there is relative to equity risk. On slide 4, very quickly, the equity beta sensitivity is really similar across the board. You're indifferent because these numbers basically all round to 0.7, but that means that when equity markets move up or down, the portfolio is likely to move in the same direction. It will move in the same direction, but will have roughly 70% of the experience. So if the equity markets go up 10%, the portfolio is likely to earn 7. Conversely, if equity markets go down 10%, portfolio is likely to earn -7. In terms of contribution to risk, again, very similar across the board, the main contributor to risk being equity risk. What I thought was interesting in this analysis is mix D is characterized as sort of the highest growth option under consideration, but it has, in fact, just a tad less equity contribution to risk than the other mixes. And that's because there's more risk, then it's more diversified, if you will. There's more risk exposure coming from principally currency and inflation hedging. I mentioned at the outset that the interest rate risk exposures are quite muted across all these mixes, except interestingly and not surprisingly, the 60-40. But at a less than 2-year duration, effective duration, we would say there's not a lot of interest rate sensitivity, which is important when we look at this next slide, where we're actually looking at these new interest or inflation scenarios that we have developed, where based upon Fed movements, what the likely or potential outcome in terms of changes in return from the risk exposures in these various portfolio alternatives. And they are relatively similar. I would say the most differentiated is the 60-40 and that mix D, that highest growth. The others you would be indifferent, but it's important to realize that even though there's relatively low interest rate sensitivity, if the Fed, for instance, acts too early and hikes rates too much, that could result in a meaningful drawdown to any of these portfolio scenarios. And conversely, if they act too late and then raise too little, so that inflation kind of runs out of control. Inflation is harmful to both equity and fixed income capital markets. So that would have a negative implication as well. In the first one, growth would be choked off too much. In the last scenario, what we call the Goldilocks scenario, if the Fed hikes just enough at just the right time, that actually should result in benefits across these respective portfolios. We also looked at historical stress and scenarios. These are actual historical events and how the portfolios would have behaved in these market environments, depending upon how the various risk exposures would have performed. And of course, it's the equity drawdowns where we see the most negative returns from a total portfolio perspective. Again, the portfolio is very similar. You do get some improvement in mix A, for example, relative to the current portfolio in the extreme drawdown scenarios, but you're essentially indifferent in most of these environments in terms of these various mixes. And then in terms of stress tests, call your attention to the two that probably are top of mind, and that would be global interest rates spiking up 200 basis points. You could see that's probably not a worst case, certainly scenario for any of these portfolios. The 60-40 would behave worse because of the fixed income orientation or higher orientation. But the portfolio does not have a lot of commodity exposure. And so if commodities were to sell off, which is the opposite of what we're seeing right now, obviously with oil prices running quite high relative to historical prices, but the portfolio should not be impacted either way because it has pretty low commodity risk exposure. So again, it's that meaningful equity drawdown, meaningful being 15% plus, in this case, negative 20%, where the total fund is likely to draw down beyond 10%. And that would be true for any of these scenarios.
So that's interesting. You know, I mean, when you look at those two slides, mix C seems to really stand out as being sort of Teflon. Am I missing something?
No, I think it's a good point, Mr. Chair, because the point I made earlier was mix C is the most differentiated because it, again, in my view, has a barbelled risk posture. I'll just jump up to that slide, it's commensurate to the slide that Laura just showed you from a capital allocation perspective. This is the slide where here you've got 13% in those immunized cash flows, very different from the other scenarios, and just slightly higher growth, but it's allocated across public and private markets, so, or mostly private market increases, and then zero commodities. So so that was my point earlier, and you're right. So in these stress tests, it does provide a little bit more differentiated and better results because of that.
Thanks, Eileen. Keep going.
That really concludes my comments. So I'm happy to entertain any additional questions the trustees may have.
Any questions for Eileen before we go through drill? Anything for Eileen?
Yeah, I think so. Eileen, thanks for the presentation. Just one comment, I guess. I think the global markets keep your job interesting because there's always scenarios that we didn't think about before.
Right.
And I think what happened in Russia, I think Russia-Ukraine kind of throws something up.
Yeah.
And I think it highlights a point which I've raised before, which is geopolitical risk. And I've frankly talked about it in the context of China-US relationship, where the threat of China either attacking Taiwan across the straits or trying to capture Senkaku Islands, which I think the US is by treaty required to protect. And I think those are not, they're not completely unrealistic scenarios, because I think if I read most of what people talked about in terms of what Russia would do or what Putin would do, very few people thought that he would actually send his army into broadly across Ukraine. You know, people talked about eastern part of Ukraine. So there may be something for the future to model to see if you use the Russia model in terms of what's happened and apply it to, you know, kind of the China situation, that may be worth looking at for the future.
Yeah, I think, you know, it's a good point. And frankly, I think, again, I go back to the slide 3 where we see such a differentiated picture from that 1 year sort of look back from risk profile is exactly, I think, what you're referring to. The market risk is increasing, has been increasing. You know, first it was COVID, and now it's these technical dislocations that I think are bleeding through these numbers. And so, yeah, I think that is something, and we'd be happy to, you know, do some work back at Veris and come back with maybe what ifs to, you know, maybe focus on how these potential risk factors might adjust where there's greater geopolitical risk.
Right, and one thing is most of these models use volatility as a measure of risk,
Yeah.
You know, which is fine, except that the real risk is the fat left tail, which is kind of what happened in Russia, where certain asset prices get marked down practically to zero, right? And that is, you know, what I call the permanent loss of capital, which you never recover. You know, volatility you can recover from. So, okay, I'd say I think it's a discussion for future, but thank you.
You're welcome. Thank you.
We're still open. Any questions for Eileen before we go into the broader debate? If you let's go ahead and do it. That worked pretty well last time. Esther, let's have you sort of tee up the debate. Prabhu, you make some comments, tee up the debate. Now we'll go round robin through the trustees, and then we'll generally open the floor up. So Esther, if you want to tee up the sort of debate or discussion, go ahead.
Yeah, I think I'll just, you know, update everybody on the discussion at the IC. And let me just pull this up here in the Makita slides. So at the IC, I think we kind of looked at, we didn't consider mix C then, so that's new. And I think there was interest both in A and B as being maybe potentially better than the current asset allocation. And if I were to kind of say, well, I mean, if you're leaning one way or the other, maybe A slightly better. But given that there was, you know, some desire to look at B, we thought maybe we can throw in something which combines these two somewhat, I guess. I'm not saying, and that was mix C, and which, as Drew and Eileen pointed out, maybe mix C gives us some interesting flexibilities, especially if there is a, you know, bigger drawdown and we want to increase risk allocation like we did in 2020, maybe it gives us a little more flexibility to be more nimble. Prabhu?
Yeah, can we actually put that up on the screen? Makita's slide 6, I believe. Yeah, just to echo Trustee Menon's comments, we did present A and B and D, and we felt that the time was not quite right for D yet. If the market falls another 10 or 15%, then it may be time to re-risk the portfolio. But the IC was evenly divided between A and B, maybe slight preference for A. And we did want to come back with mix C, which combines some of the elements of A and B, takes out our commodities allocation, and keeps the higher private markets allocation. And the reason for doing that with all these mixes, increasing our private markets allocation, is that, you know, on the one hand, we cannot increase our risk dramatically, right? Which really drives our absolute return. So we have to keep our risk because that depends on other factors, you know, the health of our sponsor, you know, the maturity of our plan, and so on. So we take all those factors into consideration in coming up with a risk tolerance. But given that risk tolerance, how best do we structure our portfolio? What portfolio do we pick from the efficient frontier? And I've advocated for some time that we actually take our exposure to private assets higher, because we can still manage our liquidity very well for the next decade or so. And there's no reason why, and I know Laura showed our, you know, our relative weighting versus our public pension plan peers. we're somewhat in line with public equity. But I've always felt, given our resources, given our governance, given the excellence of our boards and our composition of our boards, there's no reason why we should not increase our private asset mix and actually slowly shift towards what's generally called the endowment model. And I think we're fully capable of doing that. And we've taken baby steps. You know, when I joined in 2018, we had 0% exposure to venture capital. Now it's 3%. We're trying to go to 4%. I think we're fully capable of doing that. We are trying to find access to these markets, and we made some significant progress in that direction. So in general, our philosophy has been to increase our risk, increase our exposure, not our risk, to private assets at the cost of public equity. And that's what these mixes represent. But again, going back to Laura's point and to Trustee Menon's point, these are all very similar. There's not a whole lot to choose from. But Mix C, as Chair Lanza pointed out, does seem to have a little bit more diversification and a little bit more risk protection under various scenarios. So thanks to the IC for that feedback, and we came up with that Mix C.
Great. So I wanted to go ahead and go round robin now. Andrew, you're on now, aren't you?
Yeah, I'm on.
That's great. So let the record reflect that Vice Chair and Trustee Gardner is on. Andrew, I know you didn't hear the presentations, but you remember the IC. Do you have any comments?
Nothing. I mean, I thought Eswar summarized the IC conversation. I was definitely in the boat of A, but I was open to B. Main thing was to increase our private equity, which we did. Looking at the question I had coming into this discussion was on the C portfolio, and definitely the increase in the low beta portfolio. And I think Prabhu just did a good job, did a quick summary of what I missed. So, you know what? This is not my expertise area. I am open definitely to hear what the other trustees and staff thinks, but I'm definitely open to A or C. I don't think either one of those are bad options. I thought those were good options for us. So I look forward to hearing what the other trustees have to say. Thank you.
Hey, let me just jump in. I know you're in the car, Andrew. Let me point out that in terms of if what you say is right, and I agree with you, and I agree with Peru, we should increase our exposure to privates. Let me note that Mix C matches Mix B in the total percent of the portfolio spread across VC, private debt, private real estate, and private real assets. So Mix C and Mix B both, and as Bruce said, like 1% higher than Mix A. Thanks, Andrew. Sunita, any comments or questions?
Yeah, sorry, I do have a few opinions on this, but I guess it seems like between current policy and these scenarios, the material reduction in duration is in Mix C and to some extent in Mix D. And that's because we're shifting out of investment grade bonds. So I think that's something I'd love to get both Prabhu and Ishwar's thoughts on, given the interest rate cycle, given growth. I mean, I'd be supportive of reducing that. We don't have that in A and B. The second observation I have is the problem with B and C is you have zero commodity exposure in a rising inflation environment. So it makes me a little, I mean, not that 2% is a game changer, but it seems like a little backward given we just went into commodities. And the third comment I have is, I mean, I'm very comfortable with the prospect of increasing the private market exposure. That makes sense, but it's really the first two that I wasn't quite sure how to sort of trade off those factors. So I just would love to get some thoughts from Prabhu or Ishwar or anybody else.
Great questions, Trustee Sunita. So I'm going to take the first one, your first question, and I'll have Trustee Menon take your second question on commodities, since we both did discuss this quite extensively. On your first question, we felt that, it's very obvious the specter of inflation is here. And it's, how much of it, as Jared pointed out in his presentation, how much of it is really priced in? And it seems like there's there's still some amount that's probably not priced in, and there might be shocks down the road. And this was also reinforced by our speaker from Morgan Stanley the other day at the IC. And so we felt that, that shift from duration to, to T-bills may be prudent to cushion the portfolio, at least for the next, couple of years or so. And it also gives us some dry powder. Excuse me. We are in the midst of a mini market meltdown. We don't know where the S&P will settle down. But if that happens, it does give us some dry powder to increase and go to something like a mixed D. And so that was really the thinking behind that, of going from bonds to cash. And again, it's not a significant change in terms of the yield lost, since the yield is not that high to begin with. And at the same time, we are decreasing our duration risk a little bit. So that was the thinking behind your first question. And on commodities, I'm going to turn this over to Trustee Menon.
Yeah, so in reducing that 2% allocation is not a view on commodities, but just in terms of what's the best way to play it. And is a 2% allocation to commodities, is it a tool that we can use well? Because as you know, commodities can be volatile. And in my view, we're not nimble enough to play it, because you could have it go up 25% and then correct 25% before you react to it. And maybe we are not set up to do that. And so that 2% in commodities effectively goes to private markets. And I think in real assets, I think managers can make the same decisions and benefit from that commodity rising environment. So we just thought that is a better way of playing inflationary pressures.
Okay, that makes sense. That makes sense. You're right. Commodities is definitely less of a buy and hold asset class. It's much more of a trading asset class. Okay, that makes sense. So that is why C versus D. That certainly answers my question. The one thing I was going to ask you, or a thought that occurred to me, does the headline risk of moving from a 19% illiquid asset allocation to a 25% illiquid asset allocation, is there any sort of headline risk associated with that, so to speak? I mean, obviously it's consistent with our strategy to go more into private markets, but it just, it was a bit sort of, it stood out. And maybe that's a question for Veris, I don't know.
And let me answer that before Eileen, certainly free for you or Laura to jump in if you need to. The one thing I would point out is when we increase our exposure to private assets, they're really sitting in a proxy, right? So even though the eventual goal, so this is a goal, so we go from our illiquids being from 19 to 25, and that's over a 5-year period because we do have a pacing plan. So in effect, we've actually cut our exposure to public equity, increased our exposure to private equity, but the actual effect of the portfolio is almost zero, at least for the time being, because they're actually going to go and sit in a proxy and they're going to be phased over a 5-year period. And so this, the only headline risk is, what our stakeholders feel about it, right? I mean, and they are, what do our beneficiaries and stakeholders feel about it? That to me is the real question. And, our stakeholders have said in the past, particularly our city council, they've expressed some concern about fees. And that's certainly a concern when we go from public assets to private assets. And I believe we've done a reasonably good job of educating them over the past few years about the need to diversify our portfolio, the need to go into private assets and to some other illiquid asset classes, and the need to look at returns net of fees. And I think that's resonated with our city council. I think there's more education to be done. And as you know, you were with me at the city council meeting this year, and that's just an ongoing thing that we do annually. So those are my 2 comments on the increase in illiquid assets.
And then if I could comment, Mr.
Yeah, please jump in, Eileen. Laura, just jump in whenever you want to. Go ahead, Eileen.
So Trustee Ganapati, I understand what you're saying with respect to headline risk, and just a couple observations. Number one, the movement by public funds is pretty solid into greater exposure to what I would call alternatives or private markets principally. So you would not be generating what we call maverick risk, which is a source of headline risk, by increasing from 19 to 25%, because frankly, most of your sophisticated large fund, public fund peers are also migrating and may already be there at 25 and even up to 30% in private markets. Where the issue is, and the potential source of headline risk, is in the ability to have sufficient liquidity during those extreme market drawdown environments, 2008 being a good example. And at least the analysis that we've done in the risk allocation report we just presented, we don't show a greater risk to assets from that higher risk exposure to private markets, i.e. because of that mix C, principally that barbelled approach, having more assets dedicated and immunized to your cash flows to ensure that there's appropriate liquidity to meet benefit payments, to meet forward commitments, you can bear the risk of the higher private market exposure. So those should mitigate the typical source of headline risk for public funds. And I hope that answers your question.
Yeah, that certainly does. Yeah, you're right. It's a bit of optics, because you're going from 5% to 13% in immunized cash flows here. All right. Yeah, thank you very much. That was really helpful. I don't have anything else, and I certainly feel quite comfortable with C after this discussion.
Yeah, interesting. So we seem to be drifting that direction. You remember, it's the first time we've seen it too in the investment committee. So good job by the committee, even though I didn't have to do is bring it forward. Howard, any comments, questions?
Well, I guess based on what we discussed at the IC, well, first of all, thank you for the analyses. We saw it previously, but this is actually a little more illuminating. So at the IC, we talked about A and well, today's mix A and then B, and I don't think we gave C a lot of detailed discussion, but having looked at it today, and I think Sunita brought up a good point with the illiquidity percentages. Yeah, I was originally in favor of B and probably could, lean towards A previously, but I guess at this point, my view is I'm very concerned about interest rate risk and interest rate shocks, even though the Fed is trying to manage that now. I think we're in relatively uncharted territory for the Fed. So my view is that C actually does, I looked at the stress testing chart on slide 12, and C does give us a little more insulation against that. And I guess my conclusion is that I'm fully in favor of more private markets, as we discussed. And I also, since I am concerned about any kind of 200, 300 basis point risk, interest rate shock, I think B or C for me. I could go either way, but that's just my opinion right now. I think those are very good points.
Great, thanks, Howard. Ashfar, you're next in the roundtable. Why don't you? I'd prefer if you go last, and maybe if you made the motion. So, unless you have something to inject right now, you want to wait till then?
No, I can wait till the end.
That's great, thanks. Dick's not here. Franco, any questions or comments?
Yeah, no, I don't have anything.
That's great. Dave, any questions or comments?
No questions, and just thank you for the presentation.
So I'll go, and then I'll open the floor, and then I'll turn it over back to Ashfar. So I kind of agree with what you were saying, Howard. You're on the committee, and so are Andrew, Ashfar, and I. So the committee, the investment committee, basically, and staff said to Eileen and Lawrence, well, let's tweak the knobs a little bit. Maybe we'll get something better. And to be honest, I didn't know what would happen until I read the board book, and all of a sudden, goofy me, like, whoa, we did something better. I could just easily been standing here with Eileen and Laura saying, well, that didn't work real well. But you've heard it from all of us now. It's interesting. So you can turn the knobs. There's all these variables, right? What's the return? What's the risk? What's sensitivity? And we managed to turn the knob in such a way that the risk and the return rate and volatility remained about the same, but the sensitivity to shock went down. That's what you heard me ask Eileen. Eileen acknowledged that's true. You've heard Eshron Peru said, well, good. That batting 1,000 when we leave two knobs the same, turn the underlying soup, and one of the other dials goes down. So before Eshfar kind of wraps this up, Prabhu, any comments? The floor is open. Harvey, staff, public, Eileen, Laura, any comments? Jump in now.
No, I think you summarized well, Chair Lanza.
Yeah, I'm good with that, aren't I, Eileen? If not, sure, go ahead. Why don't you sum it up? And if you'd like to make a motion, I think that'd be great.
Yeah, okay. So I think the risk to mix C, which I think seems to be where the consensus is headed, is rates drop a lot, in which case I think it underperforms. And to me, if you look at the scenarios, I think one of the scenarios is Treasury bonds dropping 200 basis points, which is unlikely, just given where the 10-year yields are right now. So that's kind of my thinking. But before I make the motion, let me confirm that Prabhu is okay, that mix C makes sense. And if Laura or Eileen have anything to say also.
Yeah, thank you, Trustee Menon. Yes, I think we did, at the IC, we looked at A and B. I was slightly in favor of A. And I think C combines the best of A and B, and particularly, I think the strong point of C also is that it drops our duration. And as you rightly pointed out, yes, we could have a 200 basis point drop in yields, but very unlikely. So I do have a preference for mix C.
Laura, Eileen, anything to say?
I think it is a move in the right direction in terms of putting your risk budget where you'll get the most bang for your buck. And where you'll get the most bang for your buck is in those private markets assets, which, under any consultant's capital market assumptions demonstrate a much higher expected return than what we would expect to see from public equities and certainly public bonds. But again, as a public entity, you always have to have an eye towards ensuring that you can meet your cash flow obligations. And I think mix C, you've already got a pretty healthy liquidity profile per our quarterly risk report, but mix C further ensures that despite having a higher amount of your assets in illiquid assets, you will always be able to meet your near-term obligations no matter what the markets do.
Yeah, I would just add, we don't want to be in the business of predicting interest rate moves. While it does seem unlikely that we're going to have a drop. But that said, moving more money to cash essentially is lowering your risk, is giving you dry powder should you want to move aggressively into the markets like you were successful at in the past, and offsets the additional private markets risk.
Okay, thanks everybody. In that case, I'll move the motion that we change our strategic asset allocation to mix C.
I have a motion from Chair of the IC, Eshfar Menon. Do I have a second for that motion? I'll second. Oh, great. Sunita will second the motion. So motion by Eshfar for option C, second by Sunita. Let's go on the table. Andrew, how do you vote?
Aye.
Sunita, how do you vote?
Aye.
Howard, how do you vote?
Yes.
Eshfar, how do you vote?
Aye.
Dick's not here. Franco, how do you vote?
Aye.
And Dave, how do you vote?
Aye.
I'm Chair Lands, I vote aye. Eshfar, I think this is your first time as Chair of the IC doing an asset allocation, and you two, Prabhu, always a good job. Well done, Eshfar. Compliments. We turned the knobs, we got something better, and I think you were the one that drove that, Eshfar. So hats off to you. I'm over to you,
Prabhu,
for the last item in this section.
Yeah, thank you.
Thank you, Mr. Chairman. I do want to thank our consultants, again, for the excellent work over the past several weeks in helping us get to this point. I want to thank IC Chair Menon for also working very closely with staff as we actually, there was a lot of work that went behind, and we actually considered several mixes, but we thought it was practical to just offer 3 or 4 of the best. So a lot of work went behind the scenes, and we will consider that this is to be implemented ASAP, and we will do that as quickly as is practical and feasible. So within the next 4 to 8 weeks, we will implement this new asset allocation mix. With that, Mr. Chairman, with your permission, we would like to move to 2G.
Great, thanks, Pro. Please do.
All right, thank you. So one last item, the investment agenda. So this is again another item that was discussed at the IC, and the IC actually adopted staff's recommendation and has recommended this to the full board. Excuse me. Before I turn this over to my colleague, Mr. Jay Kwan, to talk about this agenda item, excuse me, I'd like to make some general comments. So our sponsor, the city of San Jose, they are mandated to make annual pension contributions, and they're actually, the code actually says that they ought to do it on a bi-weekly or monthly basis. But the code also gives them the flexibility to prepay this in a lump sum. And we do have a Reed Smith opinion as part of the package. And Council Leaderman several years ago, the IC posed the question to him, what tools and knobs does the board have? And the board has the ability to disincentivize the city from making a lump sum payment. And the way to do that would be to apply a discount on the actuarial equivalence of the discount rate. And this might sound very complicated, it's not. It's simple math, but we've used the same methodology. The current methodology was actually put in place by my predecessor in the year 2014. And we didn't see a real need to change the methodology. And I think the existing methodology is actually quite sound. But we've had the same methodology. We've looked at it over the past several years. It's got 2 primary drivers. One is where we are in the economic cycle, and the second is a price movement. And as an investment team, we felt that there should be a third component to it, which is valuation. And that's the component that we've added. And to actually explain this in greater detail, I'm going to turn this over to our Senior Investment Officer, Jay Kwan. Over to you, Jay.
Sure, thank you. And I'm not sure that there's a whole lot more to share beyond that summary, but I'll walk through a little bit of the detail. So as probably noted, you have several attachments to this item. One is the Reed Smith opinion, and it is from a number of years ago, but it directly pertains to this specific question, that is the board's ability to adjust the discount rate offered to the sponsor. Another attachment is the original staff memo from 2014 outlining the discount adjustment methodology. And that's the framework, as probably noted, that we've been operating under since then. And kind of long story short here, we discussed this in detail at the IC, but for you all at the board level, there's a couple triggers that in the 2014 methodology, a couple triggers that adjust the suggested discount rate downward. And those triggers are how long we've been in an economic expansion, and also how much the market has risen since some kind of market low. And so back in 2014, those triggers made a lot of sense. We were in kind of a long expansion. It had been a long time, right, since the financial crisis. And so the way those triggers were framed in 2014 were very appropriate to the conditions back then. But now we're in a situation where a couple of years since the COVID crisis, not long enough to trigger that economic expansion metric, as well as it hasn't been that much, it maybe seems like it, but it hasn't been as much of a market rise since the COVID bottom to trigger the market expansion metric. And yet, we find ourselves in a time where equities seem very expensive, right? So on a valuation basis, it doesn't seem like a very opportunistic time to throw extra money into the plan ahead of schedule. And so that prompted the introduction of a third trigger, and that's basically equity valuations as measured by the CAPE ratio on the S&P 500. And CAPE is just a long time horizon form of the pretty standard price earnings metric that I think everybody is familiar with. And so using the CAPE ratio on the S&P 500 as the metric, the triggering level for this kind of new third trigger would be 2 standard deviations above the long-term historic mean. And so this is this is a scenario that shouldn't happen that often. 2 standard deviations above the mean is a kind of very low single-digit type of occurrence, assuming a lot of statistical assumptions there. So in the IC, we talked about the fact that over the past 20-25 years, the addition of this third trigger would only really change things in the current period. So in the prior, say, a few decades, the first 2 triggers, the existing triggers, would have hit at the same time as this third trigger would have. But it's only in this current period where the first 2 triggers, the 2014 triggers, would not be activated, and this third new suggested trigger would be activated. So long story short, since the last time this came up, the sponsor, the city, got the full discount. Under the new or recommended methodology here, this would be the first year that one of the triggers is activated. And so the framework suggests that there should be a 15% discount to the 15% reduction in the discount rate offered to the sponsor. So instead of 6.625, it would be something like 5.631. And in dollar terms, for both the Tier 1 and healthcare trust put together, the dollar impact is close to $1 million. Can take any questions now if there are any kind of specifics around the incremental new trigger or process in general.
Oh, thanks, Jay. That was great. Hey, why don't we go ahead and kind of go round robin on this like we did. This actually turns out to be something that's usually kind of mundane, but I think as Jay just well highlighted, it's probably not mundane this year. We kind of see that coming, and I think what we've seen staff do is say, in reaction to the investment committee, all right, well, you say it's not mundane, but the rules say it is. Let's change the rules. I think you're wise to seeing staff saying, oh, well, let me think about how I can quantify how it's not mundane. And then we go back to Prabhu, who's been talking about CAPE forever. And it turns out, I think Prabhu has found a time when that ratio is meaningful to our core business. So let's go around the room. Andrew.
Thanks, Drew. Just one comment, and I think this is more for the future to take in consideration. Jay, I know you mentioned Tier 1, and it'd be about $1 million, a difference. One thing that when the city prepays, they get a discount, of course. If we don't hit our goal, then unfunded liability is created, which gets paid by the city for Tier 1. But now as Tier 2 becomes, starting to becoming half of Tier 1, and eventually will be, greater than Tier 1, that unfunded liability is now going to be split 50-50 between the city and the members. So is there a way to, as in the future, when Tier 2 is the majority, where you're giving the city a discount, which might in return hurt the employees, the members? I'm not sure if that makes sense, or if I'm recalling how it works correctly. Is Franco, are you able to, does that sound about right? Or Roberto?
Let me jump in, Andrew.
I can't thank you enough for the question. Let me start with that. Of course, hypothetical at this point. I think that will be that will have to really be a discussion at the board level in the future before we can answer that question. Anything is possible, but we really will need to understand, we as in the board, we need to understand the implications of various options to the membership before we can draft some sort of a process that the city can follow. As you know, at this point, that's not included because in terms of asset size, the total fund, tier 2 is so small compared to the rest of the plan that at this point, the only tier that is included for possible prepay is tier 1. But it's a good question. Again, we will have to discuss that at the board level and understand the actual implications before we can really draft a process if the board decides to move, in that fashion.
I appreciate that, Roberto. And this comment was more for put in our radar. I agree because I don't believe there was any unfunded liability. I think after last year, I don't think tier 2 had any unfunded liability. If they did, it was extremely small. But it's something that this board will have to take in consideration in the future years as the membership in tier 2 increases. So thank you.
Understood.
Yeah, and Andrew, you just got to understand that it's going to happen quickly. I think Dave will correct me if I'm wrong, but I think the tier 2s have surpassed the membership of our tier 1s for police and fire right now. So when it catches up, it's going to catch up quickly.
Yeah. For fire, we're not there yet, but we're getting close.
Any other questions, Andrew?
No, that's it. Thank you.
Thank you. Hey, Sunita, questions, comments?
I'm still trying to absorb this, I guess. Are we just voting on a possible methodology, or are we actually going to vote on using this for this year?
I assume we're voting on approving the methodology and using it for this year, right?
That is correct. Yes.
Yeah. Okay. Yeah. Keep going, Sunita.
And then I guess the second question is, does this weigh in to the pension obligation bond discussions we've been having? If we discount a pre-funding contribution, does it apply to that as well, or is it just the annual contribution?
No, this is just the city's pre-funding, the annual contribution.
Okay.
So I imagine you're right, though, Sunita. To the extent they might have a detailed mathematical model, we just turned one of the knobs. Way deep, way down, we're on 850 in the Excel spreadsheet, but this would change it. Any other questions, Sunita?
No, thank you.
Howard, over to you. Oh, you're on mute, Howard.
No, I don't have any questions. I think it makes sense. It's for this year. You're talking about extreme situations. 1 out of 20 they said was 2 sigma. So I think it makes perfect sense, at least for this year.
Great. Thanks, Howard. Ashfar, any comments, thoughts?
Yeah, thank you, Drew. We discussed it at the IC, and I've also discussed it separately with the investment team. So yeah, it makes sense. Thank you for doing the work.
Franco, any comments, questions?
No, I got nothing.
Thanks, Dave.
No, thank you.
So I'll echo what Howard said. So when I first, I got basically graduate degrees in statistics, and I first saw 2 sigma. Holy crap, that's a once every 20 years event. And then I saw, CAPE ratio. Well, Prabu's been harping on that for a bit. And I think Prabu's right. What Prabu's been saying for a long time is this ratio is like abnormally in a range it's not normally in for an abnormally long duration of time. And so I think Prabu, you sort of been saying, hey, this might be a canary in the coal mine. And I think Prabu has now told us how many minutes the canary has to sing for before we react. That's the 2 sigma thing. And I would just note in general, I think if we were to poll everybody on this call, do you think well, for sure, everybody would say, do you think the next 12 months are more uncertain than the past 48 months? Everyone would say, yes, there's a lot going on. There's Ukraine going on, inflation is rising, the end of COVID, back to normal or not, blah, blah, blah. Then you can ask them, do you think that's going to be bad news or good news? And I'm sure we'd be split, but I would bet the majority would say most of these uncertainties are not good, and therefore the financial news is now betting in Vegas. I can't read the future. I think most of the would say, yeah, I bet my money in Vegas things get worse, not better over the next 12 months. So I think this is therefore the right thing at the right time. Prabhu, you want to sum it up, and I'll make the motion if you sum it up.
Oh, excuse me, Mr. Chair.
Oh, Linda, go ahead. Thank you, Linda.
Oh, I was going to say Harvey has his hand up.
Oh, I'm sorry. Thank you, Linda. Anytime, jump in, Linda. Harvey, sorry, just jump in, Harvey.
Yeah, thanks very much. I have a slightly different perspective on this. Just stepping back, it's not that our job is to incent or disincent the city from making a lump sum contribution at the beginning of the year. And it's not that we're offering, a discount to incent or disincent. What this is really is an assessment of the actuarial equivalence between getting the money in pay period by pay period or getting the money in fully lump sum at the beginning of the year. And in normal circumstances, we would say that getting money sooner than later is worth something because we can put it out and invest it for a longer period of time than we usually assume. What we're really saying here is that there is added risk in the current market, and that's this change in the metric that Jaquan was talking about is simply a way to try to assess that risk. That there's a belief, at least that's what the motion would sound out, that under current circumstances there is heightened risk by getting all the money in and having to put it into the markets all at once rather than pay period by pay period. And therefore that risk changes the actuarial equivalent value of that money coming in, because it's not so much an incentive or disincentive to the city, is the plan taking on added risk by having all this money flood in at once. And so the 15% so-called discount off of what it otherwise might be is a recognition by the board, if the board believes this, that we're taking on added risk by bringing that money in all at once at the beginning of the year. And so that's really what this is about. We're changing, the proposal is to change the measuring stick that we're using to assess that risk. But nevertheless, the whole issue is, does the board believe it's slightly more risky under current circumstances for us to have to handle all the money and put it out in the markets right now than if we got it over pay period by pay period and could essentially dollar cost average, if you will, into the market. So I just wanted to offer that different perspective on what this exercise is that the board's undertaking. Thanks very much.
Well, as always, Harvey, well spoken and very straightforward and easy to understand. I think that's right. So it makes sense that they pre-fund us because, as you say, Harvey, we're the experts in investing money. And if they held on to it, they'd have to build up a staff as competent as ours, and that's no mean feat. It's taken us a decade to get there. And so they pre-fund, which makes us the money. But of course, that, as you say, that shifts risk. Somebody has to hold that money for a year and return something or lose something on it. And so I guess my comment to your comment, Harvey, you're welcome to jump in, would be, and so they have the ability to shift risk to us, and therefore we have to have some matching comment back. And our matching comment back is, great, we're willing to take on the risk, but as you say, Harvey, we just want to let you know, we think there's more risk than normal. Maybe as I teed it by saying, I think most people would say the future is cloudier. And furthermore, I think the market's more likely to go down. Therefore, we would say, yeah, so we respond in kind, right, Harvey? That's it. Our response is we're willing to take on that risk, but we have to have some ability to say it's riskier or less riskier this year, right?
Yeah, exactly.
Great. All right. Hey, Prabhu or Roberto, if you want to make any comments, jump in.
All right, thank you. Thank you, Chairman Laza. Thank you, Harvey, for your clarifying comments. That's exactly right. We do think that there's greater risk now. And the idea is really not to respond to changing market environments. That's really not the idea here. But it's to look at our methodology as a whole, our process as a whole, and see whether we're capturing everything, right? And something that we can actually apply to different market environments. So we've not really made a change to the methodology in 8 years. We thought that valuation was missing, and so we've added a measure to the existing methodology. And as Drew said, the Shiller PE is my favorite number, which I've been quoting for a while. And just to reinforce this, right? I mean, we think now that, the market's lost a lot of value. We're down 10% year to date, which is a big number. But just to remind everyone, Shiller PE is at 35.9. And exactly a year ago, the Shiller PE was 34.1. So it's identical to 12 months ago. So all we've done is we've just gone back to where we were March 1st, 2021. And again, this is an extremely high number, considering the fact that the mean Shiller PE of the last century was 16.92. And the all-time high was 44.19 December 1999. So this is still, we are in an extreme valuation environment. And we've been in this for an extended period of time. I think it's very prudent to modify our methodology and to add this measure. Thank you, Mr. Chair.
That's great. So I'll make the motion. Well done by you and staff. So I will move that we accept staff's recommendation to update the pre-funding discount rate calculation. We've all got the document, knowing full well that these changes, as Sunil so correctly asked, will come into play this year and will have an impact on what we tell the city for pre-funding. That's my motion. Do I have a second?
Gardner, second.
Great. I have a motion by Lanza, second by Gardner. Let's go around the room. Andrew?
Aye.
Anita?
Mr. Chairman?
Yes.
But before conducting the vote, I would recommend that we call for any public comment.
Oh, thanks, Harvey. I thought I'll floor generally open. If there's anyone from the public or staff or the city wants to jump in, feel free to. No, thanks for reminding me what my duty is, Harvey. Sunita, did we get your vote?
Yeah, and thank you very much for the discussion. It really helped clarify things. Appreciate it. Aye.
Great. Howard, how do you vote?
Yes.
Ashvar.
Aye.
Franco.
Aye.
And Dave.
Aye.
Mr. Chair Lanza, I vote aye. Hey, Roberto, I know we've got a sort of a time certain here between 10 and 11. Are we ready to do that?
Yes, Julia is available, Mr. Chair. If it's possible, I would recommend to jump to item 4C.
Right.
This item was addressed at the Federal Board meeting last month, and it should be pretty straightforward. And again, if that's an option, I will respectfully request that the board consider that. Thank you, Mr. Chair.
Yeah, that's easy. Are you going to send her a text, let her know, jump on?
She's already on
Oh,
the
hi,
Zoom.
Julia.
Yes.
Hi, Drew.
Well, why don't you go ahead and tee up item? We're going to jump to item from, hang on.
Yeah.
From two, from 2G, wow, there's a lot under, from 2G to 4C. Over to you, Roberto, and turn it over to Julia then when you want to.
Thank you. Julia, good morning. Our Director of Finance for the city. I will turn it over to Julia to present this specific item 4C. Thank you, Julia.
Okay, thank you. And I just have an oral presentation. So as Roberto mentioned, this was considered by the Federated Board last month. And this is just asking the board to approve an amended and restated MOU between the boards and the city, in which we contract with Chiron separately to review our appendix to our bond offering documents. to ensure that we've appropriately captured everything correctly with respect to both retirement plans. This is a relationship we've had for several years and it's worked very well. And we really appreciate the collaborative effort between the retirement plans, the boards, and Chiron in getting this work done. And I know Rosa in our city attorney's office worked with Harvey in drafting the amended MOU. So with that, I just ask the board's approval of the amended MOU.
Pleasure to see you, Julia. Harvey, do you want to weigh in with anything?
Only to this extent, there is no direct conflict of interest that we're worried about with the city retaining Chiron for this. It's more that because of the nature that the work is being done for the city for public bond offerings. And we just want to make clear that the retirement boards are not endorsers or subscribers to or part of the offering material. We didn't underwrite it. So this agreement just makes it clear that while the city may use the services of our contracted actuaries to perform this function for them, that it is not an endorsement or an underwriting by the retirement boards, and that it's being done at the cost of the city and not to the retirement plan.
Well said, Harvey. And I would say, Julie, we like the fact that you're like us and you do your homework and you put in your dues. So anytime we can help you to do your homework, we're all on board because I think we have the same philosophy you do. Any other remarks, Julia?
Nope.
The floor is generally open. Anybody have any questions for Julia, Harvey, Roberto on this? All right. I will. Is there any action to take, Harvey, other than saying yes, okay with us?
Yeah, just to approve the amendment to the MOU because the MOU is between the board and the city.
Well, I'll go ahead and make the motion. I move that we approve this amendment between the board and the city. Do I have a second?
Second, Botto.
That's great. Motion by Chair Lanza, second by Trustee Vado. Andrew, how do you vote?
Aye.
Sunita?
Aye.
Howard?
Yes.
Ishvar?
Aye.
Franco?
Aye.
And Dave?
Aye.
This is Chair Lanza. I vote aye too. I've got 10:45. Let's take a 5-minute break and reconvene at 10 till.
are required and that the board needs to make a decision, but we would defer to the board on the form of presentation and whether they believe they need a formal report.
Bill,
The second,
Bill, excuse me, will you take comments or questions?
Yes, I'll take
as you go along. Might be easier for the board. And
Yes.
let me, if I may, Mr. Chairman, I just want to ask one question, a clarification on the investment expense issue. I believe I'm correct to say that your expected return is based on our actual asset allocation. And based on the discussion this morning, our actual asset allocation expected return is constructed net of fees. So why wouldn't your assumed rate of return of what we actually invest in, not passive or some hypothetical active or passive, but how we actually invest. So if our expected return on our specific asset allocation is net of fees, why wouldn't the actuarially assumed rate of return be net of fees?
I think the presentation you saw this morning is done on the same basis as our assumptions. It's based on the passive equivalent of that asset allocation. So
it assumes that we're passively accessing venture capital
well, for the private asset classes, it's sort of the capital market assumptions represent the normal expected return net of typical fees.
Net of fees, yeah, and Laura could confirm this, but it's based upon how we actually invest, not how we would hypothetically invest, is my understanding.
It's based on the asset allocation. It doesn't get into which managers you select to execute that allocation.
Okay, good. I mean, I guess my point is, however we're doing it and you're basing it on should reconcile.
Yeah, I think what we would show is very similar to what Makita showed in their slide on the expected returns for 10 years and 20 years. In fact, we would show those identical numbers. I think last couple of years, we've differed slightly from Makita in our calculations for the portfolio, but not materially. But it's the same basis that they're using.
If Makita and Prabhu agree that they reconcile, then I think we're in good shape. I think that's helpful for the board to understand.
Yeah, that's correct, Harvey. So we Makita, and I think Bill's methodology is the same, ignores any active returns by manager selection on the public equity side. On the private equity side, again, we assume the median return for the asset class as opposed to being top quartile or through superior manager selection.
Thank you.
Any other questions on that? The next one is really a recommendation for the board to decide, which is that they may want to consider the deliberation of the economic assumptions earlier. So they were suggesting targeting around June 30th to select the assumptions, and that gives you more time between the selection of the assumptions and the presentation of the valuation. We've been typically presenting it in October, which is much closer to when we produce the valuation. And so we would just defer that to the board's preference in the management of their calendar. The next one is really a recommendation for ORS for the plan, that they should request a copy of the final membership data that's used in the valuation so that they can cross-check with their records. I would just note, we do regularly provide it to the auditors so that they can check and make sure that they're consistent. But we're happy to provide it to the plan as well. And I'm not even sure, we may, in the process of providing it to the auditors, it may go to the plan. The question is what the plan actually does with it. I don't think they are doing any reconciliation right now, but we would defer that to Roberto's team. The next one was about the treatment of contributions towards the OPEB that are made into the 401h account and recognizing those for refunds. We essentially agree with Siegel's suggestion here. We believe we have it under control, but we agree that we should make it clear and make sure that we are reflecting the right amount for refunds. The next one has to do with our salary increase assumptions and the reflection of the bargaining agreements. And we agree with Siegel's suggestion. The next one is that we should document in the valuation that we assume everyone earns 1 year of service in the future. I think it would be unusual to assume something else for full-time employees, but we'll add that to our report to make it clear. The next one is about the reciprocity assumption, and really is a recommendation for the next experience study. And so we will take a look at that in the next experience study. There will be an issue of balancing the accuracy versus complexity and whether this is material, but we will address that as a part of the experience study. We should prorate the COLA for tier 2 members. So tier 2 members, when they retire, their first COLA is given April 1st. In tier 1, as long as you retire before April 1st, you get the full COLA on April 1st. tier 2, it's prorated by the months you were retired before the COLA is granted. So it only affects that first COLA. We've been just assuming a full COLA because the complexity in programming that proration, we did not believe was warranted for the additional accuracy. However, we've been thinking about how we can address this, and we think we found a simple way to reflect that in our programming, so we can reflect that in next year's programming. Siegel suggested we take the 415 limitation into account. This really is just for retirees. For active members, we do take the 415 limitation into account. For retirees, we take the benefit provided to us in the data and just project it forward. The complexity with reflecting it is the people who are over the 415 limit have adjusted limits due to after-tax contributions. So we need to collect additional data to get that accurate. The impact on the valuation results is very minuscule. And so we are taking a slightly conservative approach, and we think that's appropriate given how small that difference is and the simplicity involved. Siegel suggested we should value the $1,000 post-retirement death benefit. We agree. We'll make sure that that's reflected. It's for retirees who are not married, and so they only have a life annuity benefit. So it's a smaller section of retirees, and it's just a $1,000 lump sum at the time of retirement. So it will have a very small impact. The next one was the tier 2 terminated vested retirement age assumption. We changed it in the experience study that was done. The change was reflected in our programming and in the valuation, but the valuation report did not get updated. And so we'll make sure that the report reflects the correct assumption. Modifying the tier 1 terminated vested retirement age assumption to require that 20 years have passed since the member first became a member of the plan. So if someone is a vested terminated member and doesn't have 20 years of service, they're not eligible to receive their benefits until the later of age 55 or 20 years from when they joined the plan. We just assume that they can take the benefit at age 55 for purposes of the valuation, which is slightly conservative. It currently only would affect one member as the vested terminated. And so we don't think this refinement's actually needed. We are being very slightly conservative, but it would be difficult to even detect the difference in our valuation. We should consider comparing the value of the member's deferred retirement benefit to the member's account balance. Right now, we assume that anyone who wants to take their account balance takes the refund of contributions at the time of termination. And if they don't take the refund, then we assume they're taking a deferred retirement benefit. Siegel's suggestion is slightly more conservative, and we will look at that in the next experience study. The next couple have to do with refining language in our valuation report, and we agree, and we will do that. And then the last one was an issue where we made some corrections to the data after we had sent the final data to Siegel and neglected to give them those corrections. And so we do want to apologize to Siegel for not giving them those corrections until questions arose and it was made it clear that we hadn't provided that data. So that's it. Any questions on those responses?
Before we go round robin, let me do my usual Drew Lanza knucklehead chairman thing. So I've chaired many audit committees, sat on many audit committees, and a wise chairman of a board who taught me on my first audit committee said the first question that you should ask is not what's in the 500 pages of the audit report, but are we good? Is it okay? Did you find anything major? So let me turn it over to you, Paul, not so much maybe to address point by point what Bill said, although if you'd like to, that's okay. But so are we okay, Paul? At 100,000 feet, are things good?
You are rocking. You are okay.
Great. So Paul, do you want to, for the benefit of the board, do you want to address any of the particulars that Bill talked about? Anything the board should be concerned with?
No, I do not believe there's anything here that the board should be concerned with. The main difference in practice, and this is a long established and well understood difference between how Siegel does stuff and how Chiron does stuff. And we mention it when we audit them and they mention when we audit us, and that's this how we treat investment expenses. The approach that's taken by Siegel is slightly more conservative. However, the approach taken by Chiron is consistent with the actual standards of practice and is a reasonable and acceptable methodology. So we like to point it out, but I think that Bill did a pretty good explanation of why they are comfortable with that approach. You'll see there's quite a few things here. We made minor suggestions, either about some valuation procedures or about things to document in the report. Those are basically agreed with all the way through. We're always open to the argument that some things just are not worth the effort. That is, there's more complexity. Just you don't get a return on investment to try to do that additional adjustments, but we still like to raise those. And then the one about the timing of the when the economic assumptions are reviewed each year. We've audited your systems before, and there's always this time crunch, and we just know you can get a little more breathing room by doing that review earlier. But as Bill pointed out, that's a decision for the board and your calendaring, not really a matter of actuarial practice. So, Mr. Chairman, that's our overview comment. But no, this is basically we match the numbers, and you go through and you sort of find a couple cobwebs you want to try to sweep away, but other than that, we saw nothing material.
Oh, I'm feeling good. That's great. Paul, any comments from you, Roberto, before we go round robin on this?
Yeah, I think I mentioned this again. I've been lucky enough in the industry to have worked with both firms for a long time in my current job and prior job. So I think they both do excellent work. And I think I mentioned this when Siegel actually presented the audit findings, which, I grant you that audits of actual evaluations are a little more rare than your annual financial audit attesting to the financial reports of a corporation or a department like our two plans. And so in a nutshell, what I wanted to share with you and the audience is that if you are doing an analogy between the findings of Siegel for Kairos work vis-a-vis an annual financial evaluation, this will be strictly speaking, somewhat of an unqualified opinion, where you will say that the statements are fairly stated. So I don't want to steal words from either Chiron or Siegel. Certainly, if they believe differently, they can share that. But that would be my analogy about all the type of audits that are more common that people can relate to. Thank you, Mr. Chair.
That's great. Floor is open, public, staff, Harvey. Anybody want to say anything, ask any questions?
I have a question, Chairman.
Sure, jump in, Zita.
So, I mean, this whole philosophical discussion that I guess the whole investment community always has between active managers and passive investing. I actually think Siegel raises a good question. I'm not suggesting we should change the methodology, but is there a way to address their first observation / criticism with some sort of analysis around the impact of using not a net return for as an assumption, even if it's some sort of MIS? I think that will be useful to the board, and maybe it's already done, but I thought I might raise that as opposed to saying we just have different philosophies on this.
Bill, Paul, any thoughts?
I'll do a short one, then I'll defer to Bill. I think that, Bill, check me on this, under the standard of practice, if you wanted to claim additional returns above the expenses, that is additional returns on a net basis, you would have to document that. The standard specifically says net basis when it makes that statement. And so that's why it's our understanding that the standard does not require that you document that the active managers at least cover their fees. But that would be a way to quantify it, if there'd be a way to look and see if there are incremental returns between the indexes and the active managers, and confirm that it consistently at least covers their fees. That would be a way to go.
Yeah, so in our letter, I put in what the standard states, that we should not assume superior or inferior returns net of investment expenses from active investment management. I think when we're doing this analysis, we're trying to set the expectations for the future. And I think the analysis you're suggesting is really looking at the past, and did the active managers outperform the index net of fees, or at least equal to the index net of fees. And I think that's an analysis that Makita performs for you on a regular basis, but I'm not positive on that.
Yeah, that's a good point. That's a good clarification. I think what I meant was, if the expected return was assumed with the Seagull methodology, at least for public equity and public bond funds. I understand private equity is its own beast. You probably will have a 50 basis points or whatever the amount of the fees in the future. How does it impact our unfunded liability because we are paying the extra fee?
If the impact of it was to reduce your expected return by 40 or 50 basis points, then it would increase the liability and the contributions.
Right. I mean, I understand the direction, but I'm just saying the magnitude would be something that would be perhaps something to consider inserting in your report, not changing your methodology, saying that if we are paying X amount of fees for managers in the next the horizon analysis, then our unfunded liability would go up by Y%.
Yeah, if you are paying those fees and do not get additional returns to compensate for those fees, then
that is the Seagull scenario, right?
Yeah.
Mm-hmm. Mm-hmm.
That's what I was proposing, not a back analysis. Sorry, I thank you for that clarification.
Any other questions, Anita?
No, nothing else.
I said we'd go around, Robin. We don't need to. The floor is open. Public, staff, consultants. Anybody have any more questions?
Drew, this is Andrew. I got a quick question for you.
Yeah.
One of the items is Chiron should provide prorated COLA for Tier 2 members in the 2022 valuation. And just for clarification, in there is talking about April 1st is when Tier 2 receives their COLA increases. I know I believe Federate is April 1st, but Police and Fire is February 1st. Is it different? And should we change anything in this document in regards to that? Yeah, right there.
I don't believe it's different. I think they both on February 1st, Barbara.
That's correct.
Okay, so I mean, it's just a clerical then change.
I suppose that's the case.
So ding, 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 Andrew wins the I read all 1,000 pages of the board book. Good for you, Andrew. I read that. I didn't even think twice about it. Any other questions from anyone? This is an important motion, so let me make it. I'm going to read from a script on this one. I move that we accept Siegel's actuarial audit, the pension valuation report, as of June 30, 2021, and Chiron's response to the audit. Do we have a second for that motion?
Gardner, a second.
Motion by Lanza, second by Gardner. Let's go around for the vote. Andrew?
Aye.
Sunita?
Aye.
Howard?
Yes.
Ishvar?
Aye.
Franco?
Aye.
Dave?
Aye.
As Chair Lanza, I vote aye as well. Let's just keep going. Let's power into. Let's talk about what's going to happen. So item 4C is the felony forfeiture thing. Dick wants to be on. He had an emergency board meeting. We think we're going to get Dick around 12:30. So we'll keep bumping that in the meeting until Dick shows up. That's all everything else is in order from here on, right, Roberto?
I believe that's the case, Mr. Chair.
Okay, in that case, let's power through as much of the item 4s as we can. And at noon, more or less, close to noon, when we see a breaking point, we'll take a 10-minute break for lunch and so on. So over to you, Roberto.
Yeah, thank you, Mr. Chair. So if you bear with me, I just have a couple of comments. First and foremost, I wanted to share with you that sometime back, I have mentioned that we have paused the plan of implementing the hybrid approach from our office, from having staff working remotely to start coming to the office a couple of days a week. Our goal is to kick off our plan to implement that sometime mid-month in March. Again, assuming that the pandemic or endemic is continue as it is today, and the goal is to hopefully bring back staff 2 days a week, and sort of get accustomed of having staff back at the office, make sure that it's working positively for both, for staff and for the office. But I do want to make it clear that we do have some staff at the office from day to day. And we have, even though the office is not open to the public, we do have members that come in from time to time to drop off information. And members have been making appointments, virtual appointments with staff in any case. So it's not as if we're not providing the service to the members or completing our core duties. So I just wanted to make that clear. I also wanted to share with you that we are working on the Medicare Part B reimbursement. The information is due to ORS by April 1st. It is a tedious process that we have to go through every year, and certainly working with the members of police and fire. Letters were sent out last month to about 1,200 or so eligible members. We have received little less than 50% today, about 530 applications. And staff is really targeting about 300 reimbursements per month, starting this month in March. If you then take the 300 per month, based on the 1,200 letters that were sent out, that means we will be really producing reimbursements for the next 4 months, right? March, April, May, and June. At this point, we're receiving about 10, 15 calls per day regarding the letter of the process, but so far so good. The process is going smoothly, and I will certainly keep you posted how the process ensue and develop in the next few months. The retirees impacted by 415 limits will see the 2022 adjustments in the March retirement payment this month. We have some vacancies, and the new network technician, we just made an offer. We're hoping they can start with us on Monday, March 21st. At the same time, we are in the midst of interviewing the ORS IT department managers later this month. That's the goal. And we are also going to schedule interviews for 2 positions in the benefits area. We are working on our quarterly newsletter that should be issued sometime early next month. And we will be closed for Cesar Chavez Day, March 31st. And lastly, I wanted to let you know that I asked Linda, I don't know if she's available right now, but the city council recently approved Muni Code change to Muni Code 2.08. And that's actually allows for the reappointment of trustee Dave Wilson. And the goal is for this the reads were done. They need to wait so many days to make it official. And the goal is that the city council can actually approve the reappointment in time for the April 7th meeting. So the city council meets on April 5th. And so he should be available for your April 7th meeting. Lastly, I wanted to, Linda asked me to remind everyone that now that we are sort of in the endemic as trustees, do some sort of a travel where there's some expense reimbursements, to make sure that always you run in any kind of expenses before you pay. If you decide to pay anything, run them by the office staff first, to make sure that we are following the protocol by the city and we are following the process as intended. That, Mr. Chair, concludes my comments. I'm happy to answer any questions. And Linda, if you are there and I didn't explain something correctly, or you want to provide further clarification, feel free to do that.
You did great, Roberto.
Yeah, go team. Hey, floor is open. I have a comment. I have a question, but anybody else want to go before me? Maybe more a Harvey. So I remember, Harvey, I was talking to Maytac and Roberto. So our board meeting in person, Roberto, Harvey, do we have a forecast for when we will either optionally be meeting in person or have to meet in person again? Do you know, Harvey?
Well, it's in flux. The governor's declaration of emergency based on COVID-19 is still in effect. And that's one of the 2 predicates that we continue to go 30 days at a time on. The other predicate is that the city council's resolution continues to recommend social distancing. So that's the other finding that we make. Those are still in place. My understanding is that on or about the 15th of the month, either the governor or the state legislature may take action to rescind or terminate the emergency declaration. If that happens, what is that, next week or a week and a half from now, or before the 15th, then we will be required to go back to the normal meeting rules under the Brown Act, which still has a teleconference capability, but it's not for a quorum of the board, and you still have to have posting requirements and that sort of thing. So we will have a much better idea by the 15th of the month whether we can continue to meet remotely or not. If we take action as we anticipate today, Drew, on making those findings for the board and its committees and extending the ability to meet for another 30 days, that will be undisturbed as far as we can tell by what happens on the 15th. We'll still be able to meet in early April, up to early April remotely. But stay tuned. I think it's a moving target right now at both the state and the local government level.
You got any handicap on that horse race, Harvey, or is it really a coin tossy kind of thing?
The reason why I think it's a coin toss is because we have no idea if another variant is going to show up. We thought we were out of the woods pretty much after the Delta variant, and then we got hit with Omicron. So I think I'm not a betting man on it.
All right. Let me see. Roberto, do you want to weigh in on that question?
Only that, and I'm sure Councilmember Foley may have some further comments on this. The county of Santa Clara actually lifted the mask mandates inside, I believe, yesterday. Although we as an employees of the city of San Jose did receive communication that the city was actually keeping the request of employees to wear the mask inside, at least for the time being. So even though the county did lift that, as employees of the city, we're still required to wear our masks when we're indoors. In terms of when we will start having the meetings in person, I defer to council. He's probably closer to the action than I am. But I suspect that aside or given any surprises in the next few weeks, as Council Linneman indicated, with any new variant, that we are getting very close to come back to have meetings in person. I suspect early on we'll have masks. Certainly, that's your prerogative to wear a mask if you prefer to. And we certainly will try to accommodate having enough space between everyone at the meetings. But I suspect that unless anything changes, we should start getting thinking about the fact that we may start having meetings in person relatively soon.
Thanks. So for those of you following along at home, you can summarize it thusly. We're almost certainly not going to meet in person in April, and 50-50 chance starting in May we'll be back again in person. So you don't have to get your haircuts for the next month, but probably sometime next two you probably do. Pam, over to you.
Funny. I'll start there. Thank you for letting me speak for a little bit. I know you have a huge agenda, and Chair, I need to leave soon because I have a backup committee meeting after this. So I'll leave when you break for lunch. Couple of things. First, regarding the meetings and meeting, since that's where the discussion ended, is we have moved to hybrid meetings for City Council, which means that we are meeting in person as a council, as council members, and we did so the 1st of March. It's really good to be back in person with my colleagues. It's important. It's easier to connect with them and discuss an issue when you can see them in person rather than over a Zoom call. So we started that again. By hybrid, we do still allow people to call in, but people can also come into the council chambers. And hybrid, if a council member cannot attend in person, then they can Zoom in as well. So that we're going to continue that for a while. Probably until we can no longer per the emergency order. Regarding masks, Roberto just mentioned it. Frankly, just honestly, I was kind of disappointed about that the city is going to require us to wear masks in the building when the county is no longer. And I'll just leave it at that I'm really, really disappointed. So we'll have to see how that plays out in the next couple of weeks. We did make a change to our vaccination requirements as it relates to our buildings. Remember, we had a mandate that required vaccinations, both first and second shot. Then we added in as an emergency ordinance just a couple months ago when Omicron was beginning to spike. We added in that a booster was required before you could enter any of our buildings with gatherings of 50 or more. So that's, the Shark Tank. That's any building that the city of San Jose owns. On Tuesday, we reversed that order to conform to the state, which I believe is the right thing to do. It does move up the requirement of booster shots to 1,000 per the state, but it conforms to the state guidelines, and it eliminates the uncertainty from one venue to the next, whether folks know, okay, am I boosted? Can I go in here, or am I not? Because I'm not. So I think that was a good thing. We did move forward with that. City Hall is opening up a little bit. My staff has moved back into City Hall and will meet our meeting 3 days a week. And I know a lot of city staffs are going through that same analysis. Couple big things is that on Tuesday, we reviewed 3 reports related to the George Floyd protests, and very extensive reports, over 120 pages each, some much bigger than that. One was an independent after action audit report directly related to the protest. Then another was the use of force, and another 21st century policing. All 3 reports had extensive recommendations. Some were easy to implement, some are a lot more complicated and expensive to implement. So the police department reviewed all of the recommendation and actually green lit the majority of them. There are a few that they yellow lit, but several of them have budgetary considerations, and we'll need to look at the budget for that. One in particular is training around protests and crowd control to make sure that our lieutenants and sergeants are well trained in how to deal with peaceful demonstrations, and also how to deal when there are bad actors in the peaceful demonstrations who are there just to break into buildings and cause damage. So the proposal or the recommendation is that that training be held for sergeants and lieutenants. And I agree with that. There's also the police chief is looking at having those done virtually because of cost. I completely disagree with that. I think if it's going to be effective, then our police officers, sergeants, and lieutenants need to be trained in person and have sort of real-time experiences. So we're going to look at that as a budget item. Also, just segueing into the budget, another thing about those 3 reports is that there will be technological issues that need to be addressed. We need to bring in new IT systems that will help us. But all in all, the 3 reports were beneficial. There are things that we need to take a look at and implement, and all parties have agreed to do so, that it's important that we show to our community that we're responding to what happened at the protest, but also we're incorporating best police practices and best policing available to us in the 21st century. That leads me to the next question, our next statement, which is regarding our budget. We're coming up into budget session right now. The mayor's budget message will come out first. And a priority to me is to make sure that we continue to fully fund the police department so that we can implement these changes that we need to change and bring in more officers, because part of what we continue to hear, and the police officers who are the retirees who are here and the actives who are here, they'll speak to it. We hear all the time that our police department is the most thinly staffed in the country, and we know that, and we know they're doing a yeoman's effort. I stand behind our police department 100%, but they need more resources. So we need to do what we can to bring in more resources. So that's one of my priorities. And I believe it will be the mayor's as well. Others are addressing homelessness and affordable housing. Those are huge, huge issues. So with that, I ran a little bit longer than I normally do, but I do really request your input on the budget. If you have any thoughts, it would be really helpful to me. And whether you have those comments now or you'd like to email me, please do so, because we're taking budget considerations right now. With that, thank you, Chair.
Thank you, Pam, as always, Councilman Foley. Floor's open. Staff, anybody, public, any questions for our friendly councilwoman? Going once, going twice. Sold American. All
Okay,
right.
there you go. Thank you.
There you go. Thanks, Pam. We've covered 4C about 10:45 when Julia was here. We're going to hold 4D. Dick has asked us to hold 4D. Dick he didn't ask you to hold 4E, did he? I know you talked to him about 4E, right, Roberto?
Yes, he didn't ask to hold 4E, just 4D for a later discussion when he's available later late this morning, early this afternoon.
Yeah, and I assume he told you, he told me he's fully supportive of whatever you recommend on 4E.
Yes.
Okay, Greg, well, go ahead, why don't you take 4E then, Roberto?
Thank you, Mr. Chair. If I can ask staff to bring up the memo on the screen. So while staff look for the memo and bring it on the screen, you may recall sometime back, almost a year ago, your board approved the hiring of work health solutions to provide some services, mostly board medical advisor, but it also includes some administrative services. The memo and the issue for discussion this morning is we have been working on onboarding work health solutions, and as part of that process, it includes the board medical analysis, which is actually will be provided by Dr. Das, who is well known to some of you that have a long tenure with the board. Dr. Das was the doctor for the city and provided this service to the committee and to the board when he was the doctor for the city. And so he knows our disability application process and requirements very, very well. So we're very happy about that. But the question here really was, as we are pursuing the onboarding of work health solutions, is, hey, we do have a pipeline of cases. If I can ask staff to move the memo up so I can see the pipeline. So first of all, the memo refers to the, if you can stop it right there for a second, refer to some steps on the disability application. I just wanted to remind you of that process. And then if we can go to the next page, the key question here have to do with a little more, just a tiny little bit more right there. We do have 137 police and fire disability applications in various stages of processing at this time. This particular question that I'm posing before you, board, only deals with the 17 cases between scenarios of steps 2 through 5. The 120 new applications are not, we're not asking about. That's pretty clear that those are new applications, and we will insert World Health Solution and the board medical advisor analysis on that process. But as it relates to the other scenarios, and if we can move the table up just a tiny little bit so to see scenario 2 through 5. Thank you. And so the issue is that for some of those cases, your disability committee already had Dr. Tillman's report. And so what we are recommending, and in some cases, they have been outstanding for so long that the actual BMA report is actually a prior report by Dr. Das when he was a doctor for the city. And then scenario 5 is the case has been deferred. There is no board medical advisor report. Cases can be deferred for many reasons. In instances, some instances is the applicant is not ready to continue the process, and in some others is that they have received some information that may not be in line with what they're pursuing, and could be for many of the reasons that we don't know about. So if you can move the memo down a little bit, so I can actually get to the recommendations from staff. Okay. So first of all, I want to commend staff for the detailed work here. I wanted to make sure that your board knew how many cases are in the pipeline for the solution that they are offering to your board. So below are the options for onboarding work health solutions as it relates to the service for board medical advisor. So in cases where there is a board medical advisor report from Dr. Treatment, which is really scenarios 2 and 3 above, we are recommending that the committee move forward with that information that was provided by Dr. Treatment. In cases where there is, and not to involve Dr. Das in those cases at this time. In cases where there is a prior report from Dr. Das, which is scenario 4, we are recommending to bring back and engage Dr. Das for a new board medical advisory report in that process. And certainly for cases where there is not a board medical advisory report, then the board could choose to either rely on whatever independent medical examiner report we have on board, or if the board so desire, we can engage Work Health Solution to provide a board medical advisory report, which is scenario 5. So those are the recommendations that we're putting forward for your board. We do have the benefits manager, Sandra Castellano, available. We have Barbara Heyman available and myself to really answer any questions that you may have. Thank you, Mr. Chair.
Thanks, Roger. Floor is open. Any comments, suggestions? I'm the only member of the Disability Committee on the call, so I think that's the right approach, Roberto. Oh, go ahead, jump in. Was that you, Andrew?
No, this is Ray Storms, president of the Retirees Association.
Hey, go ahead, jump in, Ray.
Just for clarification, I see it's Dr. Daz. Is that different than Dr. Doss, D-O-S-S? Are these two different people, or is it one and the same?
It's the same. I think his last name is actually D-A-S.
I thought it was Doss, D-O-S-S, but I could be wrong. Just wanted for clarification. Thank you.
No, it's Raj Das.
If I'm mistaken, staff, please correct me. You could be right. I'm not really sure. Barbara, Sandra, can you?
No, his last name is D-A-S, but it's pronounced Doss.
Okay, so but it is the same Dr. Doss that worked as a city doctor many years ago.
Yes, he was the medical director. Yes.
Thank you very much for clarifying that.
Thanks, Ray. So as the only member of the Disability Committee, yeah, I think it's the right approach, Roberto. Basically, what Roberto and staff are saying is, hey, let's not get multiple doctors weighing in, and that may strike you as, second opinions are always good. The problem with the Disability Committee is we have two very distinct types of cases. We always refer to it as the guy Dick knew that was blown off a roof one time, landed on its back and broke his spine. Yeah, you're going to get disability, man. You can't walk anymore. And you were blown off a roof fighting a fire. But there's also lots of cases, especially involving, most of us are old enough to know this, knees and hips and backs and shoulders. And they're gray. there is a gray area, and if you ask 5 medical people, you will get 5 different second opinions. And I think part of what Roberto's saying is, certainly when the applicants come in, we hear the evidence from all the doctors they've met. So we've got tons of medical evidence. And then really, we're not looking for 3 or 4 different medical opinions on our slide. One will do quite nicely, and then we can balance it against the usually 200 to 300 pages of existing medical reports, and they weigh in with opinion too. Is that fair to say, Roberto?
Yes, Mr. Chair, you're exactly right, and it also adds to the efficiency of the process. You know, we already have, I think, in many of these instances, the information that is necessary for the disability committee to make a recommendation to the board. And I'm just also looking at efficiencies here in the process, and that's part of that as well.
That's great. So the floor is open to entertain a motion to accept staff's recommendation. Come on, somebody make a motion.
Yeah, I'll move the motion, Drew.
Thanks, Ishvar. Is there a second?
Gardner.
Gardner will second. I have a motion by Ishvar and a second by Andrew. Let's go around the room. Andrew, how do you vote?
Aye.
Sunita.
Aye.
Howard.
Yes.
Ishvar.
Aye.
Franco.
Aye.
Dave.
Aye.
Mr. Chair Lanza, I vote aye as well. On to 4F. Over to you,
Mr.
Roberto.
Chairman.
Oh, yeah, go ahead, Harvey.
Sorry, just for clarification for the record, since there wasn't in the document, there's not a listed recommendation. Is the recommendation that the board just adopted from staff the 3 points that were the 3 so-called options that were made at the end of the
Thank you.
Yeah, I assume we approved. Roberto, in summary, stated his recommendation. So I assume that that's what we approved. Roberto, do you want to restate your recommendation just in case somebody's watching this on tape and doesn't want to rewind?
If staff can bring back the memo, that would be great. Thank you, council, for raising the issue. You are absolutely correct. Definitely the what we were looking for, we wanted to state it in a fashion that will provide options to the board as opposed to directing which way to proceed. But this is in essence staff recommendations. It's those 3 options, so 1, 2, and 3. That's what the motion. That's what we're looking for the motion, and I believe that's what the motion was.
Okay, terrific. Thank you.
So again, Harvey, thank you for making that clarification. I do wanted to make a side note here. Sure. It's been challenging with the pandemic and everything else, and onboarding the work health solutions. You did approve this almost a year ago. The original contract actually runs out June 30th. And as you're aware, today is March 3rd, I believe. And so we will be coming back later in the next couple of months to request an extension of the contract so they can actually do some work because they haven't really performed many board medical advisors reviews, although they started working on those already. So just a side note, to be prepared, we're going to come back to allow us to work with them for another year so we can get enough experience working with health and solutions. Thank you, Mr. Chair.
Sure, and Roberto, keep going. Why don't you do 4F? They'll probably take us to around noon, then we'll take a 10-minute break for lunch. So over to you, Roberto, for 4F.
Excuse me, Chair Santos has joined by phone. I'm
Dick
sorry, Trustee Santos.
Oh yeah, Dick, are you on? Can you hear us? Well, he's there somewhere. Why don't we go ahead and do that, Roberto? Why don't you do a 4F? We'll take a 10-minute break for lunch. And once we verify Dick can hear us and he's all set, then we'll go ahead and switch over to the one we've been
okay,
holding.
very well. So
thanks,
today we'll be on item 4G, we'll be presenting our annual request of your board of staff proposed administrative budget for next fiscal year 22-23. But before we can do that, I need to present item 4F, which actually is requesting an approval to increase the current fiscal year budget that ends on June 30th for the professional services bucket by $150,000 to a total of $1,017,000. If staff can actually bring into the screen the memo, when this part will make more sense when I actually start presenting the budget, but our annual budget presentation comprised of 4 different buckets. One is personnel, and one of them is professional services. This particular section has to do with professional services, and we only come before you board for an increase when we're going to exceed the original, what we call the original bucket expense that we presented. In this particular case, the initial budget was $867,000, which professional services is comprised of different kind of services by professionals, which include legal. This particular request have to do with legal expenses, in particular the expenses for your general and fiduciary counsel, Reed Smith. We asking for $150,000. And the reason for that increase, what we do when we put together your annual budget is we do 2 things. We look back to the last 5 years of expenses and try to get an average of those 5 years. And then we look forward as to expectations as to what may be in the horizon. And then we come to an agreement as to what is the amount that we should be requesting your board for approval. And that has worked really well over the years. This is my 10th year presenting to you a budget. It's only the 2nd time that I have to come forward before you to request an increase of any particular buckets of the last 10 years. So I think it has worked very well. In this particular case, I think the bulk of those expenses are related to the work associated with an item that we're going to be discussing later this morning, had to do with the felony forfeitures. That was nothing that we had in the pipeline, nothing that we foresee happening this year. And in order for us to be able to continue making payments under the current budget, we are asking you, we are estimating 147,000, you know, to add some buffer. We're asking for an increase of $150,000. Again, this is under the professional services bucket, but it's in particular to legal services provided by Reed Smith. I'm happy to actually answer any questions if there are any.
Floor is open. I don't know if you want to say anything, Harvey. Floor is open for anybody, anyone, public, board members. Harvey, go ahead if you want to say anything.
No, we've actually, this past year, we've experienced a spike unusual in some matters that were unanticipated, both for police and fire and federated. Happy to describe any further, but it's been an unusual year for the velocity of unanticipated legal activities.
And so let me add to that, Council Littleman. So 2 things. He did mention police and fire and federated. This is strictly costs associated with police and fire. Also wanted to mention to you, last year, Benji, if I'm mistaken, correct me. Last year, we issued an RFP for legal services, and you bore rehire, I don't know if it was last year or 2 years ago, rehire Reed Smith for legal services. And so the contract actually encompasses 5 full years. There's a total amount for that contract. We are well within that amount of that contract. But that also means that what we usually do is we kind of look at it on the annual basis. And so this is not really impacting the contract. This is just impacting the services provided in the fiscal year so that we can actually make the payments with the current fiscal year in which we are working. So did I explain that correctly, Benji?
Yes, you did. Thank you.
Thank you.
Floor still open. Any questions? I see Howard there. Howard, you got a question?
Was this, Harvey, you mentioned because it was a spike, was this sort of an exceptional year, or Roberto, for this type of increase or change?
I'll let Harvey take that issue. I can only add that, again, the bulk of these expenses are related to that particular item, felony forfeiture. Howard, this is something that came up this fiscal year. It has been in the mini code for many, many years, but it had never been raised since I've been director of the office and working with the board. So it was completely unexpected. And it has proved to be very challenging, as you may experience when we get to the next item regarding the recommendation on the process for this issue. And so I suspect that, again, has been challenging for legal as well. And so I can't speak to Reed-Smith. I'll let Harvey speak to that. But in terms of staff, that's I believe that's how we feel about it.
Okay. Yeah, we usually anticipate during any year that there'll be some, benefit appeals or things like that. This fiscal year, we were suddenly thrust into this felony forfeiture issue, which had never been approached by the board in the past, had never been presented to the board in the past, and so it's required substantial additional work that we did not anticipate in terms of crafting, as you'll see, in terms of crafting material for the board and negotiating with the city and outreach to the city and the unions. And so it's been a little more intensive than we anticipated at the beginning of the fiscal year.
Okay. Well, thank you.
Any more questions? I thought I'd entertain a motion to approve or not this increase.
Motion to approve.
That was you, Howard, right? Yeah, I got the motion by Howard. Do I have a second?
Second, Otto.
Oh, I got a motion by Howard, second by Franco. Let's go around. Andrew? Are you there, Andrew?
Aye.
Sunita?
Aye.
Howard?
Yes.
Eshvar?
Aye.
Dick, are you out there? No, I don't hear Franco. How do you vote?
Aye.
Dave?
Aye.
This is Chair Lanza. I vote aye as well. It is now exactly 12 o'clock. Spooky how that works. Let's take a break. I'm hungry. Let's take a break till 12:10, and we'll reconvene at 12:10 after we've all had a bite to eat. Thanks, everybody. See you in 10 minutes. It's 12:10. Let me fire up my iPad.
Chair Lanza, can I have a moment? This is just a friendly reminder that if you are calling in and you wish to speak, please press *6 to unmute yourself and to remute yourself when you have finished speaking. Thank you.
Oh, thanks, Michelle. Let's test that. You're talking about Dick, right, Michelle?
Yes.
Hey, Dick, if you can hear me, press *6 on your phone and say howdy. One more time, Dick. Press the star button and the 6 button and say howdy. You may not be on hearing me. All right, well, we're going to go into item 4D now. And you've sort of heard preambles of this by the fact that we've blown through our Reed Smith budget. So let me kick this off. There's been a lot of activity going on for many months in the background. I really, to be honest, haven't been privy to it because Harvey and Maytag. Oh, there he is. Hey, Dick, how you doing?
Hi, can you hear me okay?
Absolutely, Dick. Go ahead and press *6 to mute again.
I have pressed it 1,000,000 times. I've been on the
we
phone.
can hear you, so it's working. It's working, Dick.
Thank you.
Okay,
Thank you. I can hear
Dick.
you all the time. Thank you.
Well, I never shut up, so that doesn't surprise me.
That's true, Jew, but that's okay. Thank you.
So it turns out this is a big deal. I haven't been privy to it, doesn't mean it's not important. So let me make a couple of prefatory random Drew remarks. You know, if you think about it, most of what we do is dealing with the group, right? We do a discount rate for the group of all our retirees. We direct policies directed at our group, but we have individual members of our group. And we sometimes hear and rule on them. And we actually do so every month at the Disability Committee. And Dick does a great job of running the disability committees. And if you ever sat in on one of those things, we treat them with a much higher level of respect and care than we do the activities, for instance, we do with the group. So let me preface the remarks by kind of telling everybody where we are in space and time. So we have duties as board members. I'm coming up on my 50th board of directors. I've chaired 5, 6, 10 of them. So basically, let's go through our fiduciary duties really quickly. So I was taught when I became a VC, look, you have the duty of prudent care. Well, what does that mean? Well, that means care, be informed. You show up, you read the deck. Andrew pointed out he read page 867 and discovered in April rather than February. Great. And prudent, do what a prudent person would do. You also have the duty of loyalty, disclosure, and confidentiality. So loyalty, obviously straightforward. If you have conflicting loyalties, bring them up, maybe recuse yourself. I did recently on a VC thing. And then confidentiality, you don't go blabbing what we're talking about, especially if you're doing closed session. And then disclosure, show up, tell everybody everything you know, don't hide stuff. But there's even a more fundamental duty, and we don't usually talk about it because it's so obvious. And that's the first duty of all board meetings. It's called, I have to look it up, it's called the duty of good faith. It's pretty straightforward. It just means we follow the law. And if I'm also on a homeowner association board, we have rules, covenants, and restrictions. I have to follow those. So the interesting thing is we're going to deal with a case probably in May where the law is involved. And this ain't just like law rule number 867 subparagraph C. These are laws that go all the way back 4,000 years to the Code of Hammurabi. And you may know them more recently, 800 years ago as Magna Carta. And for those of you for whom high school civics is still current, you'll recognize them as the foundations of our country and our Constitution. They also constitute the first paragraph in the California State Constitution. So we are an agent of the state. And all of those rules that I'm referring to are what we generally lump into something called due process. And the reason why Reed Smith has spent a lot of money is to make damn sure that we know what due process means in this case. Now you might ask yourself, why the heck do we have to figure it out? Well, when the city granted us a power to take away people's pensions if they break the law, felony forfeiture, felony, broke the law, forfeiture, we have the right to take away their pension. The city didn't tell us and follow this set of rules. So we had to appeal to a higher authority, the US Constitution and the California State Constitution, to understand what those rules were. And that involved Maytac talking to counsel for these people that are coming under us, felony forfeiture, talking to city, and so on. So I will remind the board that we do this every month in disability. So, you know, what's a cornerstone due process? Well, you read Maytac's excellent brief, and it's pretty straightforward. We all know this. 3 core elements of due process. First of all, you get notified something's going on. You've been accused of something, there's a hearing, disability. So in fact, we work closely with the disability applicants over many years, and we make sure that when their hearing comes up, and as Roberto said, sometimes 4 or 5 years later, they work with us, we pick a date, they get to be there. That's the first thing, right? Second piece of due process, you're involved in the process. So if you've ever been to a disability committee meeting, most of the applicants have legal counsel. Sam Swift, for instance, is probably legal counsel to athletes. We have a lawyer, Russ Ricada, who used to be our counsel before Harvey, is in those meetings, and they're conducted like you would expect. The people that are asking for disability have the right to bring witnesses. We have the right to bring witnesses. That's what Roberto's talking about. Raj Das, and people before him, right? And they bring hundreds of pages of medical reports, right? We have had actual physicians get on our Zoom calls and interact with us, right? And the final piece of due process is your right to an impartial decision. And we know that as a right to trial by your peers, say. And Dick and I can promise you Dick does a great job running those meetings. We try as hard as we can to be impartial and fair, often, as we alluded to earlier, in a gray zone. So where are we in space and time? Probably in May, maybe later, we will actually hear the cases of, there's 2 gentlemen, if I believe that's right, and we have the right, the responsibility to potentially impact, take away all of it if we so choose, their pensions. Final thought. All we're doing today is voting on the rules that we'll use during that hearing. Final thought for everyone on board. Every vote so far in this meeting has been unanimous. This hearing, maybe even the rules for this hearing, are not going to be unanimous. That's okay. I do not want this board to strive for unanimity. I want it to strive for consensus, which means the majority of us think we should go right or left or up or down, not all of us. And what does consensus mean? Once we voted and chosen, we all get on board with that and follow it, right? Consensus is not unanimity. It's the group votes, we choose. And the whole point of consensus, everybody says, well, I don't want to go right, but the team wants to go right. I'm going right with the team, with the board. Anything, Harvey, you want to then kick this off and then we'll switch around, Robin?
Sure, I'd be happy to do that. And thanks for the preliminary comments, Drew. Drew is absolutely correct. What we're talking about here is setting up the rules that we will govern ourselves by when we consider these things. I will say this, we've engaged with the city attorney's office on these things because they do impact labor relations significantly. And as late as last night, the city attorney's office requested that we not actually take a final vote on this matter, that we defer it a bit more to give them an opportunity to continue their dialogue with the POA, Police Officers Association. And out of respect for that process, what I would recommend that we do today is that we treat this as, in the nature of a first reading, and not actually vote on it today, but come back in April and conduct a vote on it, so that the city and the POA and any other interested parties, Local 230, for example, can have a fair time to consider the issue as well. This is not, today we're not talking about taking any dispositive action on anybody's benefit. We're talking about where are the chalk lines on the field that will govern how we conduct ourselves. And the reason why that's important, Drew mentions fundamental rights. It is a long fundamental matter of law that a pension benefit is deferred compensation that is earned by a member under the rules that are in place for that benefit while the member is employed. It has on the books of the city, both in the city charter and in the city municipal code, for well over 100 years, there has been a provision that says that if a member commits treason or is convicted of a felony, that their rights to their pension may be deprived to them. That is the kind of thing that is a taking under constitutional law and under fundamental US constitutional law. You cannot take away someone's property right unless you give them fundamental and fair due process. So for better or for worse, it came to our attention within the last 8 months, I think it's been, that there was this provision in the city charter and municipal code that delegated the responsibility of making a determination as to whether or not to impact the retirement allowance of members to this board. In other words, there was a delegation from the city council to this board, and to this board and the exercise and the sole exercise of the board's discretion. We're a public body, and we exercise discretion on many things: disability benefits, regular benefits, actuarial issues, contribution rates. But we're measured by the standard of whether or not we have abused our discretion. If someone is aggrieved by some exercise of discretion that this board makes, they get to go to court. And if they can demonstrate that we did so arbitrarily and capricious and without reasonable basis, then they can have our decision overturned as an abuse of discretion. One of the fundamental ways of establishing abuse of discretion is if the body that's exercising its discretion, its judgment, does not do so fairly and in recognition of the due process rights of the member. And so what we focus on at this stage is a set of guideposts, due process guideposts, that assure the member that if their fundamental right to a retirement benefit is going to be affected negatively by this board, that they have notice that we're going to consider the matter, that they have timely opportunity to defend themselves, to put forward material that is in their favor, that it is a level playing field and there's no prejudice by the board in making this determination within its discretion, that they can bring to the process and to the proceeding any witnesses. They can be represented. Their beneficiaries whose benefits might be affected are also put on notice. so that when they come here, they know that this is not some kind of a kangaroo court, but is instead a process that respects their fundamental rights and benefits. And that's what this is designed to do. It's designed to avoid any claim that we abused our discretion by not establishing a level playing field in advance of hearing any specific case for any specific member. We have in place, for example, the same kind of due process for disability applications that the Disability Committee and this board follows by allowing this to be fairly heard. This is not something new, but it's new because of the subject matter. And in my memory, this board has never been presented with, in the past, a convicted felon, a member of the system, and considered the issue of whether or not, under the code, some or all of that member's benefits should be deprived to that member. So we're talking here just about fair due process. I had a couple, and looking over the materials again, we keep refining them. I have a couple of minor tweaks that I'd like to offer to the board for consideration. We can do that now, or we can do that if the board agrees to use this as a first reading today. But I would recommend, out of respect for the request of the city attorney's office to help promote their discussions with labor groups, that we not vote today, but vote, put this over for a final second reading and vote at the April board meeting. I'm happy to answer any questions that anybody has on this. I hesitate to repeat the extensive memorandum that we've given you. I will tell you that both Maytac, Chin, and myself have, for other systems in the state, have successfully handled several felony forfeiture cases within the last couple of years. For other systems, county systems, and for the state system, CalPERS, CalSTRS, the UC Regents, the law changed in 2013, and a specific felony forfeiture law was written into the books that govern the county and state systems. And we've had, as you can imagine, a number of issues that have had to be decided in terms of due process and in terms of fundamental rights of members. So there have been now, as cited in our memorandum, there have been a number of appellate decisions that have dealt with the concept of due process in this context. And so we have substantial experience now statewide that really informs how to craft a policy for this board that will withstand judicial scrutiny, and more importantly, is fundamentally fair to the member whose benefits are at issue. But happy to answer any questions, Mr. Chairman, and members of the board, and also want to encourage you to open the conversation up to members of the public.
Yep.
Maybe dialing in so that we have a full and robust conversation about this.
Great. So why don't we proceed as follows? I'll make a few remarks. I want Roberto, who's been really at the center of this with Harvey and Maytac, make a few remarks. Then we'll go round robin in alphabetical order, and then we'll open the floor generally up for comments. So let me just make one final comment along the lines of Harvey. So it wouldn't stun me if this video is being watched in a courtroom in 3 or 4 years. And so let me address the people watching this. I think the charge will be that because we were given this responsibility with no mention of due process, that somehow that's a faulty thing. So it's not a faulty thing. We all took high school civics. We're all well aware of the fact that we're agents of the state. We're all well aware of the fact that we're operating under the US Constitution and the Constitution of California. And let me point out, we also mentioned Magna Carta and the Codes of Hammurabi. So we are well aware of our duties. We are well aware that we are responsible for ensuring that any members who come under felony forfeiture must be granted full due process rights. And finally, let me point out, as Harvey has said and I've said, we do this every month in disability committee hearings. Our members are almost always represented by counsel. I've been doing disabilities with Dick now, I don't know, 5, 6 years and longer on the board. We've never, ever had anyone, either a member or their counsel, say that we were not following due process. So if you're watching this in the year 2026, we are taking this seriously. We're going to actually discuss the procedure we're going to use to make sure we have due process. And Roberto, I know you've been in the Senate for almost a year. What do you want to say? And they'll go round robin.
Thank you, Mr. Chair. I don't think that I can add any more words than you have and Harvey explained. I think this has been a process that has been led by our fiduciary counsel and Makita in this particular case. And I wholeheartedly believe that due process is critical to implementing this particular process, right? Again, I can't emphasize enough, this is not about how you will be deciding these cases, which they are very individual cases in the future whenever they come up to your board. This is just about setting up a process that when a member have to go through this process, they understand, transparency, what kind of documents are due, what's the timeline, who they're going to be presenting, whether they can make attorneys, what is the process like. So this is just really addressing all those issues as the board embark on making these decisions in the future. There is a clear and distinct approach as to how this is going to be handled with each member that is in a consistent basis before they come before your board for a final decision. So again, great work. I know Maytag has been in communication with the city. I think as Council Lideman indicated, we heard from the city yesterday, and we are mindful of the need by the city as the employer to have communications and understanding and answer questions of the bargaining units. Just as much as I would recommend that not only we seek input from the audience, but that, as any members listening to this meeting that want to speak on behalf of the bargaining units, that also share any thoughts or ask any questions of the board this afternoon on this issue. So thank you, Mr. Chair.
Thanks, Roberto. Hey, Franco, I forgot to mention, obviously, it's the first time the board's seeing it as a board, but not the first time the board's seeing it. Franco, I don't know if you want to make some remarks before I go round robin. You guys have been working on this for a long time, I know.
Yeah, just because I think I know we talked about this slightly at the last meeting. There's two parts to this. One is the process, as was just described. What I don't like that's currently in existence right now is the fact that there's no process. The language is written and basically says the retirement board has full discretion. So they can do whatever they want as written now. What we've come up with Maytag was a due process. And I think that's an important part of this. But the secondary part of it, which is more important and why the bargaining units need to be involved with it, is under what circumstances. I said at the last meeting, I'm riding my bicycle, I'm drunk, and I hit someone, they fall and they break their arm. That's a felony. I'm going to lose my pension for that. So the two parts to it is, one, are we going to give them a due process? How they get notified, what rights they have, do they get an attorney to represent them, or does this just go straight to court? And then the second fold, which I really think Local 230, the POA, and the Retiree Association should be involved with, is under what circumstances can this be done? And that's really what's important here. And I know Dave probably has, you know, some input in this as well. And I do believe the POA's attorneys on there, Drew, so you know, give him an opportunity to, you know, opine as well.
That's really helpful. Thanks, Franco. So before I go around robin one more time, so Harvey says today, let's guys just look at it and start talk. Next month, let's vote on process, and then May or June we will actually hear the cases, I suppose you'd call them. So Andrew, go ahead and jump in.
I don't have too much to say. I mean, I think Drew, Harvey, Roberto, and Franco, you know, summarize it really well. You know, we don't have a process in place. This puts one. It gives it an opportunity for everybody that needs to be involved to have equal voice and to share information. I know we all want to jump to the other part, which is, you know, how are we going to decide? That will come. But today, you know, based off the memo that Harvey and Maytak Chin, you know, provided us today, I think the process and the bullet points that's showing up on the screen right now provide a good framework for that process to happen. So I know today is a first reading on it, but as I see it right now, there are no red flags that I see in regards to the process. And I look forward to hearing about other people's comments. And I know the harder work is ahead of us. Thanks.
Thanks, Andrew. Sunita, any comments?
No, I got a good download on the governance meeting, so no comment. Thank you.
I'm going to go in alphabetical order. Lanza comes before Lee in the alphabet. So let me echo what Franco said. So when I finally did get involved about a month ago, I asked Maytak, well, how big is that dial? What we do to their pension? And Maytak said, echoing what Franco was saying, was in a bike accident, was drunk, but was taking the bike to go help somebody. We don't have to touch their pension at all. You can imagine a case, it's not this case, but you can imagine a case where a police officer, a retired police officer was found guilty after they retired of killing their partner while on duty in order to protect a crime, in order to cover up a crime. That's not nothing to do with what happened this time. I would imagine we'd take away all their pension. And Maytak says, Drew, in every shade of gray in between. We can take away 13%, 82%, 56%. I think Frank is alluding to that. So it's important that we recognize we have, as Howard said, extremely broad discretion, not only to set the rules, but then also to set the nature of the penalty. Over to you, Howard. Any questions, comments?
No, it's pretty clear to me. I guess one of the questions I have, maybe Harvey, you mentioned that the other systems have gone through this and have set up procedures. Was it based on that case that's in the memo, the Hipshire case?
Yeah, that was the first case, Howard, that percolated up to the appellate court level. It came out of Los Angeles. And what happened there, briefly, is this was a case of a firefighter running a gambling operation out of the firehouse and was convicted of a felony. The retirement board believed it was the responsibility of the plan sponsor, the county, to provide a hearing with due process. And so the big difference in the county and state law compared to our law is that there's no discretion in the retirement board to do it. If the statute there says that if someone is convicted of a felony, then, and it's brought to the attention of the retirement board shall recalculate the benefit to take the entire service time that's related to the felony out of the benefit. It's a mandatory. There's no judgment call by the retirement board. And so the only issue that came up there was not whether they should do it, but how they should go about doing it. and whose responsibility it is to give a due notice opportunity to the member before that forfeiture happens. And what happened was the retirement board thought that was the responsibility of the county plan sponsor. County plan sponsor didn't do it. And so it went up to the appellate court on both constitutional issues, but also this process issue. And the appellate court said, no, it's the retirement board's responsibility to conduct a due process procedure. And so it sent it back down to the retirement board to do that. It said that's not the responsibility of the employer, the plan sponsor, it's the responsibility of the retirement board that's actually affecting the benefit change. And so that resolved statewide the issue of due process in one of these felony forfeiture cases. And that has been applied now in several other cases successfully. Once that decision came down, we crafted procedures for our other county system clients so that they would have the due process in place when these matters come up. But again, I say in the state and county law, it's a mandatory adjustment of the benefit. It's not let up to the discretion of the board. It's a very different situation than we have. Ours is cries out even more for due process, because if you're going to be exercising discretionary judgment over someone's benefit, you know, as Drew says, you know, 50%, 20%, 82%, you've got to have some fundamental framework that allows a fair opportunity for the affected member to come in and represent themselves.
Yeah. Okay. Thanks, Harvey. Now, I think it makes logical sense, and I don't see any reason not to have it. I mean, that's what became very clear to me, and I appreciate this, what you said, especially Franco. I didn't realize to the extent that there's this other aspect, which I think, am I correct in saying that that's going to be a separate topic, as Andrew said, the actual, I guess, figuring out what is the threshold by which a recalculation or forfeiture would occur? Is that a separate?
Yeah, there are many, many, many issues that would come to bear on that. When did it happen? Was it during service or not? Was the felony committed after the member was in retirement status, for example? Was it committed during service? Was it, in other words, service connected? Did it deprive the employer of the honest services of the member? What was the gravity of it? All these questions will be addressed in the context of an individual who falls under the potential forfeiture because they've been convicted of a felony. These have come up in other cases. They're relevant under other laws that deal with felony forfeiture. We just happen to have on the books of this city, a forfeiture statute that is so broadly written that it gives our board no guidance on how to make those judgment calls. But we will, in the context of actual member proceedings, we will help educate the board on the various factors that bear on whether or not it's fair and reasonable, as Franco says, whether it's reasonable under the circumstances to apply some or all of the forfeiture.
Mm-hmm.
Now, that'll come much later in the consideration of a specific case.
Okay. Yeah, thank you. Thank you, Harvey.
So let me weigh in, because I deal with this every day on boards. So that's why we're not going to reach unanimity. And the consensus itself may be hard, because the whole reason why boards are constituted is because we are the various interests. We're the taxpayers. Franco is a retired guy. Dave is an active guy. We are the representative interests. We are not supposed to think alike. Although if we all thought alike, why would we have a board? And so I think you're right, Howard, Harvey, when that calculus comes in, and Franco's alluding to, there's all the 100 factors, I'm almost certainly not going to see it through the same lens that Franco does, although I'm going to listen carefully to his lens because it's much more well-developed and sharper than mine. So when we finally get to this, I don't expect we're all going to want to do the same thing. And so this may take multiple board meetings. And this is part of the reason I have not been directly involved, because I've recognized that my responsibility is yet to come. It'll be to try to run chair over those meetings, which will be hard. Fortunately, in my world, we have 2 times when we have meetings like that. One's when we fire a founding CEO, and one's when we sell a company. And you don't get unanimity. Most startup companies you do. On those issues, you want a diversity opinion. You want to actually have to move to democratic voting processes. All right, Dick, do you want to weigh in? Any thoughts or comments?
Excuse me, Mr. Chair.
Yeah.
Ray Storms and Greg Adam has their hands up.
Ray, let's go round robin on the trustees, and then we'll come to you guys. I want to make sure we hear all the trustees first. You know, I'm fair about that stuff. Dick, anything you want to weigh in on this?
Oh, yes, I could probably sit here for the next hour. I really appreciate the conversations that's being stated. Can you hear me okay? Can you hear me okay?
Yep, you're coming in. Sorry, Dick, I was on mute. You're coming in loud and clear, brother.
Okay, thank you. The first question I asked Harvey, and I need clarification. This is a municipal code, and is the city council adamant about this process, or would it? So that's the first thing I have to know. This is a municipal code, is it not?
Correct.
Okay, so do we know that the city council wants us to go forward with this, with the retirement board?
The city council put this on the books 60 years ago.
I understand. I'm trying to do some common sense here before we get into all the technical stuff. How do we know that they want to continue pursuing it this way? Maybe they don't. I understand what you said. You and I have had many conversations over this. I've had probably in 24 years about 10 different cases that we had that never came up to this thing. And as you know, we don't wear black robes. So what you're saying is, I really appreciate Drew and you with all the information you're given. I would like to question first, does the city council want to continue pursuing this through the retirement system? That's all.
To my knowledge, the city council has not expressed any view on it one way or another, other than what they put on the books, Dick. And since it's part of our plan responsibilities, it really doesn't matter from day to day whether the city council wants us to exercise our responsibility or not. And until they make a change in it, they've passed the responsibility to make that decision to us.
Well, thank you for that. I think that's why we have to wait and find out what the POA and Local 230 and retirees will be talking about. I won't comment anymore. I've got a lot of things to say and clear up, but I really appreciate the work you have all done to try to make the playing field level at all times. I respect that. Drew has been outstanding as a civilian coming into this board, and Harvey, your leadership has been wonderful with the legal. So I appreciate that, and I'll just wait till someone else. Thank you.
That's great, Dick. We'll have more chances to speak before we move on next time. Franco, been waiting to hear what you have to say, brother.
Yeah, I really don't have anything else to add other than what I said. I think this is going to be a very complex process, and we definitely need the stakeholders involved, meaning the POA, Local 230, and the Retirees Association.
So, Franco, you're pretty confident. You're pretty confident you can sort of represent the general viewpoint of your constituency, right? That's part of your job, is to bring to the board kind of what you're pretty confident you sort of have the pulse on your retired police guys?
Yeah, I am.
Good, great. That's super. And that will be why we disagree, because retired police guys may not think the same thing as taxpayers. I'm not quite sure who my constituency is. I guess I'll figure that out as we go. But the whole point of boards is that we bring forward all these constituencies, right? And while we represent them, we bring their message to the board, we do what's in the best interest of the plan. So our members may want us to do, our constituency may want us to do something that's not in the best interest of the plan. Our fiduciary duty says, nuh-uh. I know my higher duty is to the plan, And that's why boards, you could go back 2,000 years to Rome. That's why boards exist. Dave, over to you. What do you think?
I don't have much to add. I wanted to thank Council Leaderman for making the motion or the suggestion that we don't have a vote today and put this off and give all the representative parties a chance to weigh in. And all the issues that he brought up on for the second phase of this, what events would actually trigger it. I was happy to hear that we were thinking along the same lines of the considerations that need to be taken into account.
All right, why don't we go ahead and do the following then? Why don't we go ahead and we'll go through, go ahead. Yes, go ahead.
Drew, just, I didn't speak, but so in 20.
I'm sorry, yes, right. I lost the thread there.
Well,
sorry.
I know. So when people watch in 2026, they're going to make sure all trustees spoke. So
that's a good point.
So yeah, no, I think I actually enjoyed the discussion here. I think great points by you, by Franco, by Javi. And I think page 2, the process seems to be kind of well thought out and drawn. So I think it's a good step. I like it.
That's great. And sorry, Asher, I owe you a beer for that. Why don't we go ahead and go around where the hands are up, and then we'll open the floor up for trustees, staff, consultants, public speak. So who was it? It was Ray. Do you notice what order they put their hands up in, Linda, by any chance?
Greg Adam had his name up first.
Okay, Greg, why don't you jump in and tell us what you'd like to. Tell us who you are first, Greg, and your background.
Yeah, I actually thought about my background. I think one of my kids has been fiddling with my background, not intending to have Benny Hill up here.
But, no, I'm sorry. I actually like Benny Hill. I meant your background. What brings you to our meeting?
Yeah, hey, my name's Greg Adam. I've been had the honor of being the POA's attorney for about a dozen years now, and enjoyed myself during all the Measure B battles and what have you. And obviously a very interesting discussion today. A lot of valid points. I agree with Harvey's point initially that there not be a final vote. We've requested to meet and confer with the city, and as the speakers have mentioned, I think there's a lot of points to cover. This has obviously been on the books for a while, this provision, right? But I don't know that it's been used very often. One has the sense, given what's going on in our wide and wonderful world, that it may be invoked more often in the future. And in fact, Mr. Chairperson, you referenced the fact that you got a couple of hearings in the pipeline. So I think there are a number of important issues. Franco raised a very important one, which is, I think notice not only goes to notice about what the hearing consists of and notice that your pension is under some kind of threat, but also notice about, what is the extent of that threat? Is it your entire pension? What standards are the board going to be operating under as they consider whether it's a complete elimination of all that somebody's been working for their entire professional life versus, a 5% or whatever. I note that in the Hipshire case, which Harvey talked about, as mentioned in the memo, the gambling syndicate operating firefighter in that case lost a percentage of his pension. The whole thing wasn't taken away. He was being prosecuted by the feds. I forget what the exact pension percentage amount was, but that's important. And I'm aware of another case in a different jurisdiction that I'm going to base a hypothetical on to give you kind of a more practical understanding of why this kind of stuff matters. So, our retirees, our cops, our firefighters, our retirees are humans, right? They're going to make mistakes. We all make mistakes. And I want you to imagine you find yourself in a situation where, through a mistake or whatever, you're facing felony charges. And as happens when one is facing felony charges, you may be offered some kind of plea deal, right? And, you know, maybe it's a plea deal that avoids prison time or gives you the lowest level of felony that's out there. And you're going to be weighing up any number of impacts of that. I think it's important for you also to know what is the potential impact if you were to agree to some kind of plea deal. That may take care of your criminal process, but what is going to be, are you going to have any idea as to what's going to happen to you with your pension? Something, again, you may have worked all your career on, and you may be anticipating that that pension is basically the lifeblood for you and your family going forward. So I think there are a number of really important issues to work through to analyze these issues. The board, obviously, you get great legal advice, and just by the tone of the discussion so far, I think everybody gets the importance of it. So on behalf of the POA, we look forward to participating, to having a robust discussion on this, and really coming up with the best rules and best notice that we possibly can for the benefit of everybody impacted. Thank you.
Thanks, Greg. Nice to meet you. I would point out to the board, there's something, there are two councils on this call, Greg and Harvey, have alluded to that I didn't quite realize until a couple weeks ago. So there's a big bundle of money in our system that's backing up their pensions. And as Harvey said, you dig in that bundle of money, the dollar bills all have different colors. So two examples right off the bat, one Harvey mentioned, one is, remember, our members put in money. So there's some dollar bills in that bag that we're holding, giving its pension, put in by him and some put in by the taxpayers. And Harvey alluded to another one. Let's say, and I don't know anything about this case. I've deliberately not found anything about it. Let's say the crime was committed 12 years into a 24-year service. Well, there's some dollar bills that went in before the crime and some dollar bills that went in after the crime. And I'm sure there's 100 colors of dollar bills in there. So it's tricky. Ray, you had your hand up. Over to you. You might be on mute. You're on mute, Ray.
Sorry about that. For those of you that don't know, my name is Ray Storms. I'm president of the San Jose Retirees Association for both police and fire. And today, I wanted to be clear, we do not oppose revoking someone's pension who has committed an egregious crime that impacts our community. And what determines egregious, that's going to be something you're going to have to come up with. However, this issue that seems simple on its face, but has broad ramifications. It's difficult for both the retirees and their beneficiaries. The entire important staff should reach out to key stakeholders when considering these major policy issues input. That would include us. As our association, we're approximately a little over 1,400 members, and this affects our members. And actually, we haven't really been reached out to. I know you reached out to the POA. I know they're reaching out to Local 230. But when you start talking about pensions, you're talking about really retired people. Now, did this ad happen when they were on duty, or did this happen years after they were retired? Or is there going to be a statute of limitations? Is it fair to go back 30 years and ask the accused to defend themselves? There's got, what are the limitations? What criteria are you going to look at with the beneficiaries? I mean, this is, the person goes to jail. What about his children, the wife? They didn't commit the crime, but yet that pension that was supposed to go to them to help now may or may not. And I know you're going to look at this in the rules. I know you.
Yeah. Hey, Ray, hold that thought for a minute. Hey, Linda, do we need to ask Ray to just pause for a minute while they switch video?
Yes, please.
Hey, Ray, just hold that thought for a minute because I got a little alarm that just went off. That you stay with me, Ray.
No problem.
Right. So hang on. Hey, Linda, how will we know when they've switched video? Will we get a notice?
No, it's 5 minutes, 1 o'clock to 1:05.
Oh, hey, Ray, can you hold that thought for 5 minutes, Ray? I don't think I can hold that thought for 90 seconds.
Yeah.
All right, everybody, let's take a 5-minute break. Let's come back at 1:05 when they pick the tape up again. Ray, it's still your floor.
Okay, sorry about that. We mentioned the statute of limitations. Also, on the felonies, was it a felony when he committed the crime or she committed the crime? And is it still a felony, or was it not a felony there and now it is? You know, that's something to look at. It's real simple. Somebody did something in year 10 of their career, they go another 20 years and they've been retired for 20. How far back do we go on that? You know, and how are you notified? That's another key issue. Somebody living out of state, would you have been notified that they committed a felony somewhere? And is it going to be during your time of work, or is it going to be after you retired that you committed a felony of some sort? I know these are a lot of answers that you have to look at. I'm just putting them out to say, hey, this is something that needs to be looked at. Frank already hit on, are all felonies equal? And they're not, you know. And then I think a big point here is, how would you educate every current retirement member that this policy affects every current retiree and active vested member? So they have to be notified at some point that this is something that's being enforced. Not that it would prevent them from committing a crime, but just like it was said earlier, maybe from not doing a plea deal. I start looking at it. Does this also affect the federated? And that I don't know. And I know that's not our area, but even so, you know, it's a huge undertaking for this whole process. And I really would appreciate if you would consider our association before considering the final policy, so we can have input and have a good look at it, just to see if we see something that jumps out at us that's like, wait a second. And I know this is difficult, don't get me wrong. I totally understand how difficult this is. But I think we need involvement of all stakeholders. And I think I've hit on everything I was going to mention.
So you're actually raising a really interesting point, Ray, which we run into in startup boards all the time. So the whole point of this board is that you are supposed to be represented on this board. You're supposed to be. And just like in a startup board, we have directors who represent founders, directors who represent employees, directors who represent investors, right? But it isn't always the case that those representatives are, in fact, fully representing the interests of the group that is their constituents. So Harvey, I know how we deal with this in startup world. How do you sort of deal with Ray's request here in the public sector union world?
Harvey, can I jump in quickly on that
please.
question? And Ray, I apologize because you're absolutely right. I know I had it on my notes to reach out to you before the meeting a couple of weeks ago, but it's my fault. I did not. And so no problem. This is no different than any of the issues when we want to really receive input from constituents and from membership and the public in general. As we work through this, I'm happy to add you to make sure that the Retiree Association is keep informed. And of course, when the next public meeting comes up, even though I think Drew was referring to a representative for the retirees, which is Franco, the young Franco Vado, I'll make sure that you guys have that information, and you know, you're able to make further comments. So if your group decides to bring your attorney as well, we want to make sure that this is discussed in detail, and we have all the input necessary to make sure that we implement an appropriate process. So no problem with that.
Yeah, my concern there was, and we have great reps on the board, both active and retired. But with that said, when I did the stakeholders meeting with the mayor, Sam Licardo, we had a stakeholders meeting, and I was on that, but yet I'm not local 230, I'm not POA. We're something different. And if it's going to affect the members that we have, we want to know. I know the POA and local 230 start with active, and know those actives are going to sooner or later become retirees. So they have our best interest at involved also. But as my board that looks at it, we also say, okay, we need to be advised of this and kind of get an idea of what's going on and see if any input from us is necessary. Thank you for your time.
So Harvey, how do we sort of, we deal with this all the time in startup land where the various constituencies really want to be part of the discussion, not just speak through their representatives. What's your thoughts on that, Harvey?
Well, that's both formal and informal. In this process, I know that we've kind of deferred somewhat to the city because the city has notice requirements regarding their active members organizations. It's really on an informal basis that we would, that ORS would communicate outside of the posted agendas with the Retiree Association, and that's great. But that's more of an informal relationship. Now, the retiree, Ray, your group, I hope, is on the the list for getting circulation of all public agendized meetings and the backup material, and that's a week before. And so this, I hope that your organization, for example, was aware of the governance committee proceedings and had an opportunity to attend those sessions, because those are all public meetings, just like this one. But sure, however we can magnify the communications with members, however they're organized, whether individually or in the association, and that we can improve communications, let's just do it. That's just part of, good service to our community. No problem there. And I hope you've been getting notice of the various meetings and the backup materials so that you can assess that and decide whether or not to attend those meetings as well. Just the same as this one.
Yes, I generally look on the agenda for this meeting, see what's been covered and what's looking in the future, and see if anything that affects police and fire retirees. And that's when I'll come in and get involved, or one of the board members will. But we hadn't gotten involved with the convenience group, and maybe we should have. So,
well, it's plenty of time. Ray,
I'm sorry.
Go ahead. No, go
I'll
ahead.
also say, I think once we were able to refine before the governance committee that we were only going to deal at this stage with the due process for our members and putting into place the procedures, that we weren't going to do with those bigger issues, Ray, that you and Franco talk about, and Greg Adam talked about, which, how to apply it and how to exercise the board's discretion on what factors. Certainly when that comes up, we'll try our best to do an outreach to all the interested stakeholders, so that you can have an opportunity to weigh in on those.
Much appreciated.
Yeah, and you have my personal commitment. I'm sure I speak for the whole board. This train's not leaving the station until it's fully provisioned. Everybody's on board, so that's pretty easy. Floor is open. Public members, staff, consultants, board members, jump in. Anybody have a thought? Just go ahead and jump in. Wow, we really are a high function board. So Franco, God bless you, man. I think you really teed this up nicely. So I'm kind of a naif on this stuff. So, and you're saying it's right, Harvey. So Franco, Ray, everybody's sort of saying there's kind of this middle ground. So now we know we're going to do it right. We haven't done it yet. And this middle ground, I know Maytac talked to me about this when I had a call with her 2 weeks ago. Sort of, okay, so what are the guidelines, right? I mean, what can we consider? I suppose that's case law. What should we consider? I mean, Harvey, Franco's frame is this middle ground, and you sort of see it. Can you tee up that middle ground for us next month, Harvey? Does that make sense?
We can tee up in a hypothetical vacuum, if you will, the various factors that might come to play in making the determination. It probably makes more sense to do that in the context of a specific situation, specific members. Just so the board knows, we have 3 members that have been identified to us. First, there were 2, and then a third one came about, who have been convicted of felonies, and therefore the application of this code section will be triggered in connection with their individual benefits. We have had long conversations and scheduling issues, and for the first 2 of those, they are represented by counsel, and they've asked for personal reasons. Originally, we were going to schedule that proceeding for those 2 considerations at the April board meeting. They've asked to continue it till May, and we've agreed to that. So tentatively, at the May board meeting, we will have scheduled the first 2 of the outstanding 3 pending felony forfeiture matters. It probably makes some sense to brief the board on the various factors at that May meeting when the issue comes up. Doesn't mean that the board has to rule any particular way at that meeting, but you know, as Oliver Wendell Holmes once said, if only as a concession to the shortness of life, you have to draw a line somewhere, and we have to get something scheduled because this has been hanging out there on these members for several months, and we'd like to be able to proceed, and they'd like to be able to proceed. So I guess what I'm suggesting, we could go either way, but what I'm suggesting is maybe we talk about the various factors and how they impact the board's decision in the context of real cases as opposed to hypotheticals.
Let me think about that for a minute. Well, can you abstract part of that, Harvey, maybe for next? I know what you're saying, but can you abstract part of that for next? For instance, I don't know, can we take away money he put in the plan? Somebody asked a question, can we take away money for the maybe widow at some point in time? Can you just give us some general guidelines along really a very broad frame, as if anybody were looking at any case?
Oh, sure. I mean, we've tried to answer the questions that you just raised.
Yeah.
We in our current memo, we try to explain the breadth of the statutes that were given to implement, and they are broad. I mean, it's from 0 to 100% of the members' benefit. It's from 0 to 100% of any future survivor benefit. It can affect, some of that money can be diverted, if you will, or paid directly to a spouse or dependent children if necessary for necessities of life. I mean, it is extremely broad authority that the board has been given to make a judgment call and to parse the benefit any way the board believes is appropriate under the circumstances. So I think the key here is, what does it mean? What are the circumstances? Under what circumstances? That's really what the issue is for the board. And I mean, if you like, when this comes back, if the board agrees today to this being a first reading and to take no action on it till April, we can, when this comes back, we can have one agenda item for adoption of the procedure, and then another agenda item for a discussion about the circumstances under which the board might apply its judgment as to a forfeiture of benefits. So if you'd like to do it that way, we can certainly tee that up for the board at the April meeting.
Yeah, I think that Harvey, unless somebody objects, why don't we go ahead and do that? Because yeah, I read the whole 59-page brief and I got a lot of that out, but of course it's sort of sprinkled throughout. And to some extent, what Franco has done, I think really well, is sort of said there is this middle ground. Well, let's go ahead and identify that middle ground to the extent we can. And I hear what you're saying, which is, well, the middle ground is very fluid and applies case by case. So look, I mean, tell me if I'm wrong, Harvey, sort of the core question in my mind is, and Franco sort of raised it, is we're all going to come into that meeting where we hear these with our own frames, and we should come into that meeting with our own frames. But do we have some language? So when Franco says, no, Drew, I think this factor is more important than that, and therefore this should be the number. And I say, you know, Franco, I don't agree. Do we have some language that allows Franco and I to converse? And that's kind of does that make sense, Harvey? That's kind of the memo, I guess, would be handed out for next month.
Yes, we can do that.
Yeah, that makes sense. So, right, Harvey, some common language. So we're all talking English, you know what I mean?
Yep.
Yep, great. Okay. Floor's still open. Anybody want to jump in? There isn't a need for a motion, but the floor is open for a motion. I don't think we need one, but if somebody wants to make a motion, they might.
Well, Mr. Chair, we just should have consensus to go to April.
Yeah. Does anybody object to anything at this point? I'll read that as consensus to move forward. Again, Ray, everybody else, you know us all, and if we're not hearing your voices, by all means, reach out to us in the city. We are committed to that, as Roberto says.
Our recommendation, Mr. Chairman, is our recommendation is to receive and file this matter and to re-agendize it for action at the April meeting.
I think that is what we should do, Harvey. Thank you. That is wise counsel. I suppose final summary thought, Harvey, it sounds like we got a bit of our own little hipster going on here, where we're not quite clear what the city should do and we should do, and that's great, probably as it should be. All right, Roberto, you want to tee up the next item?
I'd be happy, Mr. Chair. Of course, I'll try to, if I can ask staff to bring the agenda to the right. I'm assuming the next item is the budget because I just saw the screen popping up.
4G. Yeah, 4G.
Yes, thank you.
You're on target, yeah.
Yes. So I know it's been a long meeting, so I will take my time with the presentation, but I'd be a little more general so that we can continue with the process. But of course, if you have questions, you can stop me throughout. As we do every year, around this time, we bring before you the proposal for the administrative budget. We have two of them. We have one for police and fire, your board, and then later this month, I will be presenting the one for federated. The process is such that after both of you boards hopefully coming to an agreement with our proposed budget, then it sort of goes, it's already at the city level, but then it goes to the city council, and in May, the city council then approve their city budget, which includes the budget for appointees, which is what our office is considered an appointee office of the city council. And as part of this process, I also have to reach out to the mayor's office, sort of to explain our rationale for the request. And so your item actually has a couple of attachments, has a presentation. I'm going to limit my comments because of time to the presentation and our request, but there's also a memorandum explaining the process, and there's also a document that we prepare for the city budget office, which actually provides a lot more detail. That information is a little different than what you see here. The numbers are the same, but they have a little more detail in that they include expected income for the year. Please note that for the expected income from the year, the proposed budget, what we assume is that we take the basis of our plan size, and then we actually add the expected rate of return. Of course, we have no knowledge, no idea, regardless of the fact that I ask Prabhu every year how much we're going to earn for the fiscal year. He can never, ever tell me a number. So what we do is we use the expected rate of return, and then also based on that return stream that we're expecting, which, as you probably know, is just a guess, we also provide a detail of the expenses. What goes to the city is a lot more than just administrative expenses. It's also expenses in terms of making benefit payments, payments to investment managers, and everything else. Not to complicate matters, but that's one of the biggest differences between how the city has over time requested this budget process to be delineated and approved, and how we and the board has maintained the position that you approve the administrative budget, which is what we're presenting to you this afternoon, and the rest of those expenses, for example, those that we payments that we made for services and fees to the money managers, that is actually subtracted out of the plan. So we don't budget for that because we have no idea how much the plan is going to return over the year. So it's just a guessing game. But for purposes of the city process, we prepare all this information, assuming that we're going to earn the assumed rate of return. So now with that sort of explain how we develop the budget. I'm going to be going over the administrative expense breakdown, sources of funds, uses of funds, and then our proposed budget, which I mentioned before. We came before you for a request to increase our professional services. In that item about an hour ago, I mentioned 4 buckets. The 4 buckets of your budget are personnel services, which is the compensation and benefits related to the personnel for the office. We also have a bucket for non-personnel equipment analysis, professional services, and then lastly, medical services, right? And then we close the presentation comparing our actual costs of prior fiscal years with our peers across the state, so that you get a sense of how reasonable is our administrative budget every year. So with that, if we can go to the next slide. So when we develop the budget process, as I mentioned before, this specifically has to do with what actually documentation we send to the city budget office. And so the sources of funds of our plan includes the city contributions, the participant contributions, and again, the investment income. As you know, the investment income for the fiscal year ending June 30, 2021, we had probably the best year ever, and it was astronomical. But when we put a budget together, we assume we're going to earn the assumed rate of return. In terms of the uses of funds, as I mentioned, we have benefits and health insurance, pension payments, and we include the administrative expense, which is really the cost associated with running the office, which is what we're presenting to you for approval this afternoon. If you can go to the next slide. So for the budget, which actually includes the time frame of July 1st, 2022 to June 30th, 2023, again, the request is include 4 buckets. And the first one is personnel. We don't really keep track on a daily basis how much time staff spend working on police and fire and federated. We are very different than our peers across the state. As far as I'm concerned, we are the only office that provides services with the same staff to different boards. There are a couple of other systems that have staff for a couple of plans, but they only have one board. As far as I'm concerned, San Jose is the only one that I know that actually has two separate boards for the two plans. And it was decided a long time ago that for purposes of the investment staff, not for purposes of the rest of the salary and benefits for the rest of the office, but as it relates to investment staff, we split the cost 60% for police and fire, 40% for federated, because that's sort of the split of the total assets of the plans. When you combine both plans, about 60% of total assets belong to police and fire, and about 40% of them belong to federated. Then we have another bucket, which is non-personnel equipment. That's the administrative overhead costs. It includes the rent for the office, supplies, equipment, but it does not include professional services. When we go through the presentation, we will have a detail of what those expenses are, by the way. Then the next item is professional services, and that's legal, actuarial, IT, accounting, and other kind of consulting services. And then we close it with the medical services, which is the cost associated with having to do with the disability application process, medical advisor, independent medical examiner, so on and so forth. If we can go to the next item. So in terms of sources of funds, you can see here, I was referring to the fiscal year that just ended last year in 21. If you would have seen this slide a couple of years ago, the forecast would have been based on the assumed rate of return, but as you can see, the actual investment income was over $1 billion, right? And then of course we include participant contributions and city contributions. We are forecasting for the current year ending on June 30th, 22, again, investment income based on the assumed rate of return. So obviously Prabhu has some work to do to get us to that number for the next few months. And then we are adding the participant contributions and city contributions that are required based on the prior actuarial evaluation. And then for the proposed, which is the proposal that we are presenting to you this afternoon, again, investment income based on strictly the assumed rate of return, which is actually 6.625%, along with the participant contributions and city contributions that are based on the most recent actuarial evaluation. On the other hand, the uses of funds, again, all this detail is mostly presented to the city and is for the city process and the budget office and the city council. But one thing that we agreed the last couple of years based on the audit by the auditor for the city was that we were going to present the same information to the boards that we are presenting to city council. So that's why we're going to this detail. And this is the same concept of the sources of funds, but these are the uses of funds. So that's what you see prior years with actual numbers, the current year that is ending in a few months forecasted, and then the proposed for 22, 23. The biggest item here you can imagine is the pension benefits. As you can see, today, the total pension benefits for the police and fire are already about $250 million every year. We also have disbursements for health insurance, and then the portion that we're presenting to you, right, the administrative expense, which, as you can see, for the proposal is going to be just north of $6 million for next year. If you can go to the next slide. By the way, I know I'm kind of going quickly through this. If you have any questions as I'm speaking about this slide, feel free to stop me. So in essence, this is what we are requesting of you, board, for approval for the proposed administrative budget for fiscal year 22-23. Again, these are the four buckets: personnel, non-personnel equipment, professional services, and medical services. The total amount that we are proposing is $6,326,000. On the right-hand side, we have some lines explaining the difference between number one, the adopted for last year and the forecasted for this year, but we also show you the difference between what we are forecasting for the year versus what we are proposing. For example, one area that we always has a difference, even though it's not the biggest one this year, is personnel services. And that's very easy to explain. The proposed budget, which you'll see our org chart in a second, includes all the positions, assuming that they have been fully staffed all year. In reality, what happened is I've been here close to 10 years. We have never been in the situation where we are 100% staffed. As I mentioned during my audit report, we are working on making offers or interviews for positions that are vacant. So usually what you see the difference between the forecast and the proposed is that some positions have been vacant throughout the year, so we don't really pay the full amount of what was proposed. So that's the difference between C and D of 18.65. On the other hand, let me touch base on the biggest difference here, which is the medical services. It's twofold. We had Dr. Tima last year, and she worked through almost May or June. It has taken us some time to onboard the new process of the work health solution. As you heard this in the morning, the presentation on how to onboard the board medical advisor and what to use the new board medical advisor for which cases. They just are going to start doing that kind of work. So that's why the forecast amount is actually almost just a little more than half what was adopted last year. For the proposed number, we have a very aggressive number, and that's because we expect Work Health Solutions to be fully onboarded and engaged by the time we hit the new fiscal year. And we have a goal to reduce the pipeline of the applications that are outstanding. So that take into account administrative expense work by Work Health Solutions, as well as costs associated with independent medical examiners and the board medical advisors. So many cases throughout the year. And so that's why you see a big difference between what is being proposed and the forecast for this year. And so that's why you have that 323.4%. So in general, the total between what was adopted and is forecasted this year and the proposed, again, is between the adopted, it was just a little bit more than 6 million. We're asking for 6,326,000. And but when you compare that to the forecast, it's a difference of about 14%. We can go to the next slide. So that was the budget in general. Now we're going to go through each one of the different 4 buckets. So again, the proposed for personal services is 4,463,000. This is a combination of compensation and benefits for all the positions. You can see that throughout this year, we have 40 positions that have been authorized. In fact, this is the first year since I've been here working with both boards that we have requested and are considering adding 3 positions at once, almost a 10% increase. The 3 positions are all the positions that we are requesting are for the benefits area. And so what we do is we allocate the positions half and half for both plans. That's why you see a total of 43. For purposes of the budget, you see 21.5, which is half of the 43, because we charge half of the cost to police and fire and half to federated. If we can go to the next slide for a second. So I wanted to call attention. This is the org chart as we speak. For those of you that are fairly new to the process, the Chief Executive Officer, myself, and the Chief Investment Officer, Prabhu, we are 2 employees that really do not report to the city. We report directly to both boards. There is a line of my name to the city council. That's because the employees of the office are city employees, and then of course both boards also go up to the city council because they are ultimately appointed by the city council. So that's why you have it in this fashion. And then below the CEO, you have all the senior staff, and then you have the different section. Right to your left, you have the investment group led by Prabhu. You have also our administrative staff, which is led by Linda Alexander. You have the senior internal auditor, human, which sort of report to myself indirectly, but really reports to both audit committee chairs. Then further below, you have the benefits manager, Sandra Castellano, who leads the benefits staff. And on the right-hand side, you have the deputy director, who is actually Prabhu leads the investment side, and Barbara leads the operational side. So all those three areas of information technology, benefits, and accounting reports to Barbara. And under Barbara, you also have, of course, Benji Chuafoy, who's the accounting manager. And then, of course, you have the technology manager, which is at this point vacant. But when I wanted to call your attention for the three buckets that are, I think that's light gray, the three positions that we are requesting, I actually reach out to the mayor's office. And at this point, my understanding is that they supporting our request for the three new positions. So you see the positions that we are requesting. There are two seniors. There's a senior benefit analyst for the pension side of the equation. Benefits is split between two sides. There's the health side of it, and then there's the pension. And then we also are requesting a senior analyst, which is also another proposed position for the administration of the pension process. In addition, we're adding an analyst 2 under the benefits function. And again, we have an extensive group, but we were a little light on supervisory duties. And so this is really looking to have that kind of knowledge and supervision more directly with the staff to help the managers be more strategic in nature. And so I'm happy to answer any questions you may have about this, but in a nutshell, that is the proposed org chart for the office and the three new positions that we are requesting. If we can go to the next slide. So that actually is the 43 positions for personnel. The next item is non-personnel equipment. The adopted for last year was 726,000. The forecast is just shy of 700, and we are proposing 795,000, about a 10% increase. Please note, no personal equipment increase in prior budget by 69,000, and it's mainly due to this hasn't come to you; it will come later. But fiduciary insurance is increasing so far. Our understanding is that it will be increasing by about $44,000. So that's what you see there, plus CPI increases on all the other areas, and that's the main difference here between the proposed and the adopted. The non-personal equipment, if you can go to the next slide. So again, I just wanted to make sure that you understood what's included in this bucket. The two biggest are, number one, the fiduciary and commercial liability insurance. As we explained, we expected that it will be increased about 45,000. And then there is the rent for our office. We occupy a portion of the 6th floor and a portion of the 5th floor. We also have IT, hardware and software of about 109,000. And then the rest of the costs, posters and printing, LRS, which is the administrative pension system, some training and travel for board and staff, and other non-personnel and equipment, all together makes 795,000. Again, I'm happy to entertain any questions, particularly to these items, but if there are none, we can move to the next slide. So the next compensation is, the next bucket is professional services. As you remember, you just approved an increase of 150,000. That's why the adopted modify goes up in here from 867 to 1,017,000 versus a proposed of 798,000, a decrease of about 21.5% compared to the adopted for the current year. And again, professional services decreased by 69,000, mainly due to the fact that the actuarial audit for $100,000 is only done every 5 years. So we don't, the cost is associated with this year audits, and we don't have to pay for it next year. And then other considerations is we do have some costs associated with the LRS, the new pension administration system, that are not included in the budget because, again, those are not expenses that we incur. These are costs that are capped towards the cost of the equipment. It's not really an expense that we include in the budget. And then the following slide actually includes a list of all the professional. The largest figure is the legal, and that legal actually encompasses all our legal fees and services. The biggest one, which is Reed Smith, because it's your general and fiduciary counsel. Saltzman and Johnson actually provide disability counsel, and then Ice Miller, which is mostly tax, and then that's 275,000. A note, and I explain this every year, we do have also investment counsel, but the cost associated with investment counsel is not included in this number, and that's because under California law, investment related expenses are subtracted from the earnings of the plan, and they are not to be included in the administrative budget. So any investment expense associated with, that's why in this budget you do not see our expenses related to money managers, because it's not part of the administrative expense. Neither did you see then in this case investment expenses related to legal. The other item is actuary, 262,000. I mentioned before that we do have some vacancies throughout the year, and how we take care of those vacancies is, since that sometimes takes time to actually fill, we do have contracts with a temporary agency that provides some staff, and so we use that contract to fill those positions from time to time. The audit is the annual financial audit, and then other professional services and the pension administration system web changes, which are billed by the hour. That together is a total of $798,000. As I explained before, what we do is we look backwards 5 years, and we actually take an average of those 5 years, and then we look forward to expected processes, so things that we're expecting to take place in the following year, and we come to an amount that makes sense, and that's how we arrive to this number. So the next bucket is medical services. Again, this is strictly associated with your disability process. It's an aggressive proposal of 270,000 because we're expecting to complete considerably more cases than last year and decrease the pipeline. Again, this includes your board medical advisor, independent medical examiners, even some administrative costs associated with some of the work that Work Health Solution is going to be providing to our staff. I won't go into the details, but if there are any questions about this slide, I'm happy to address them. If not, then we can go to the next slide. So in a nutshell, that is the proposal for the budget. This slide, when I first came in about 10 years ago, I instituted a process that ideally the goal is to provide your board a sense. So how do you compare in terms of our administrative budget with our peers across the state? Now, again, I did mention before, we as an office, we're a bit of a different than our peers, right? Because we are the only board, the only staff that I know. We're not the only one that actually provides services to 2 plans, but we are the only one I know provides services to 2 plans and 2 separate boards. So what we do here is we combine some of the information. So I'm going to touch base in here on the 8 basis points on police and fire, and then the combined plans, right? Because that also makes sense. So in terms of the police and fire, the actual was 8 basis point, and of course you just went over the $5 billion, but back then in 2021, you were between the 0 and 5 billion, and I think we're marked. We are represented by the 0. So if you can see, we are right around what we should be. So the average for California public plans in a range of 0 to 5 is 7 basis points, and police and fire is 8 for 2021. We were 9 for 1920 compared to about 9 for our peers. So again, the concept here is to give you a sense of the expenses that we are requesting, how we compare to our peers. Now, when I present this data to Federated, they always complain because obviously they have the same staff, but they have a lower base. So they're going to look more expensive than you do, right? That's why you have 10 basis points for Federated versus 8 for police and fire. So another way to look at this is look at the combined office. Combined, we are just north of 8 billion. So that will put us in the second average for California public pension plans between 5 and 10 billion. As you can see, the combined San Jose plans of 8 basis points is in line with the 8 basis points for the same range for other plans in California. In terms of personnel, again, if there are any questions, please stop me and I'm happy to address it. That one was specifically related to the total budget. This one is personnel services. And I'm sorry, that one was personnel. This is personnel, but that was basis points. This is dollar figures. And again, as a police and fire, in this particular slide, you are in the 0 to 5, 3.7 versus 2.1, and the combined 6.9 versus 5.5. Now, this is a very easy one to explain. You can see that compared to our peers, not only police and fire on its own, but when we combine both plans as a combined office to either the 0 to 5 for police and fire or the 5 to 10 billion for the peer plans, we look more expensive. And that makes sense. And why do I say that? It's actually twofold. The first one is, it is more expensive to pay for salaries and benefits in the Bay Area than it is in other parts of the state, especially in the Central Valley. Many of you know that the bulk of my experience before I came to San Jose was in the Central Valley, and the compensation there is considerably lower than it is in the Bay Area. So that's part of it. The second one is by design. These boards elected some time ago to really develop a deep bench on the investment staff. We are very proud of our CIO and how he leads his staff. Very strong staff in terms of not only expenses, but educational background and a very deep bench. And that approach costs money. That is different than what other systems have elected to do, where they may just have one individual or two. For example, many of you know Darren Miller. He was our senior investment officer that actually left to join Kern County as a CIO. Kern County is about a $4 or $5 billion plan, very similar to police and fire. And I believe that his staff consists of himself and maybe one more staff or two. So again, if you compare the investment staff costs associated with Kern County and us, is going to be astronomical difference, but that's a decision by the board of that composition. So that's what you see reflected here in terms of the dollars. Any questions about this particular slide? If not, we can go to the next slide. Now, this is actually a comparison in terms of the administrative cost for the total proposal. Now, in this one, again, these are actual numbers. So these are from prior years. Police and fire, 12 basis points, compared to the 14 basis point for plans between 0 and 5 billion. So it was actually, you were a lot more efficient than your peers. But if I was sitting here presenting this to Federated, they would not be happy. Which is the reason why we provide the combined, which I think is a better explanation, again, because we don't keep track of the expenses or the time that staff spend for each plan, other than for investment issues. 60% of the cost goes to police and 40 to Federated, the rest is 50-50. So because Federated is going to have a lower base, it's going to look more expensive. So in this particular case, if I was talking to Federated, I would key in that they should be comparing themselves in the combined. Even still, when you have the combined of 14 basis point compared to the range of 5 to 10 billion of 11 basis points, we seem a little more expensive. But nevertheless, it's still within the range. Of course, if you look at police and fire compared to your range of 0 to 5, you look less expensive than your peers, which may sense to some extent because there are some economies of scale as you become larger. But again, same concept of the personnel, but this is for the total administrative cost. And again, this is in basis points. And the next slide would be the dollar figure. Exactly right. Combined plans for 2021, 11.3. And again, considerably more than the public pension plans of 5 to 10 billion, 7.8. A caveat here is that I mentioned already that your board elected to develop and implement a very deep bench in investment staff, which is comprised of not only the investment side of the equation, but also the operational side, which is close to eight seats. And I have elected over the years to include the personnel costs associated with investments in the budget. If I was following the California code to the letter in terms of investment related expenses are deducted directly from the earnings, you would argue that we could decide not to include it in the administrative expenses because they are strictly investment related expenses. I have chosen repeatedly and consistently over the years not to do that because when I go to the city council to have the budget approved, I have to present our personnel requests. And a big part of our personnel request is the investment staff. So I have elected over the years to be consistent on what I present to you board and what I present to the city council. But I will argue that the bulk of that there have to do with the fact that, number one, many of our peer plans don't have a large investment staff. And if they do, they may be electing not to include investment expenses. And that's not what we're electing to do. So that's the basic explanation for the difference here in terms of the dollars, not only for police and fire specifically, but for the combined amount between the 11.3 and 11.1 versus the 7.8 and 10.7, even though, and this is a good question, Benji, I'm sorry to put you on the spot. Sorry, I apologize. I should have read this before. If you look at 19 and 20 numbers, we have 11.1 versus 10.7, but then 20 to 21, 11.3 to 7.8. Any sense of what caused for our peers that huge difference between 10.7 and 7.8?
Anyone?
Benji, are you there? You may be on mute if we cannot hear you.
Sorry, yes, I was on mute.
Okay.
I think the reason is, well, one of the reasons is because one of the ACFRs, Sacramento, which is in our peer group, their ACFR was not available at the time this was completed. So last year it was included in there, but this year it's not.
Oh, well. And then the other explanation for such a big difference is that Sacramento was not included.
Right.
So yeah.
You should see the footnote on the bottom of the page.
Yeah. Oh, that's right. It is. It just see Benji. It's just too small of a letter there. Sacramento and Merced were not available. So that makes me feel better. So in the prior slide and this slide, we should keep our comments to the 2019 and 20 numbers because they makes more sense, right? So when you look at the combined of 11.1 versus 10.7, there's not much of a difference. Again, the goal here is to provide you board with a sense that what we are presenting to you as a proposal and what we are requesting for you to approve is within the line of our peers across the state. Hopefully that, that message is coming across. If we can go to the next slide.
That's it. That's
it. That's the end of the presentation. I'm happy to answer any questions that you may have.
Mr. Chair, I have a question.
Jump in, Dick.
Yeah, Roberto, does the Federated share our potential disability medical services?
Yes, they have their own costs associated with their work. Yes, this is completely separate.
But separate, how come we don't join together and cut the cost if that's possible?
No. We join, but for purposes of the presentation, we actually separate the costs, right? Because they have less disability cases than in your case, and that's what I mean. But we do get benefits of scale because we use both plans use the same IMEs and the board of medical advisor. Yes.
I'm not complaining, but 323% increase in medical services just seems to be outrageous.
It is. And so let me go back to that. It is, but actually, I thought I explained the rationale behind it. The reason for that, Dick, is you may recall that we were losing Dr. Treatment last year, and then we had a difficult time, not only through the RFP, but onboarding Work Health Solutions. So that increased our pipeline of cases that are outstanding. And so what you see in the proposal, $270,000, which is a 300% increase from the adopted for last year, is our goal, Dick, to actually accomplish more disability applications this year than in the past, because we want to reduce the pipeline. So in terms of overall dollars, it looks a lot higher and outrageous, but please be assured that the cost is very similar. It's just that we're expecting to get a lot more work done than we've done in the past. That's the goal. That will mean that we also keep you and Drew a lot busier in the disability committee meetings.
Now, the reason I make those comments are, it seemed like Drew and I, along with our panel and yourself, has tried to streamline things, not make it easier, but we have not farmed a lot of stuff out and tried to deal what we have. And I thought that was very complimentary to see the cost increase. I just don't get it, but thank you.
Okay.
Rather than go round robin, that was so thorough. Floor's open. Any trustee have any questions for Roberto? Jump in. Members of the public, any of our consultants, anybody want to jump in with anything? So you're looking to approve this meeting, right, Roberto?
Yes, I am, because the next meeting this month, we presenting Federated, and then that would allow us to take it to the city council early May.
The floor is open. Everybody want to make a motion to approve this budget?
Santos, motion to support.
Santos will support. Dave, you want to second that?
Yeah, I'll second it.
Great. Andrew?
Aye.
Sunita?
Aye.
Howard?
Yes.
Ashfar? Ashfar had drop off. Dick?
Yes, and thank you for the explanation.
Franco?
Aye.
Dave?
Aye.
I'm sure lands and I vote aye. 4H, Barbara's presentation on comp plan. Roberto, you want to make any prefatory remarks?
Yeah, other than Barbara is very excited to be presenting to you this afternoon. You may recall that you approved the communication strategic plan some time back, and we promised to come before you on 6-month intervals to provide you an update, and that's what Barbara will be doing now. So with that, I'll turn it over to Barbara, who's leading the charge on the communication plan. Barbara, welcome.
Thank you, Roberto. Good afternoon. Barbara Heyman, Deputy Director for ORS. This memo is, as Roberto mentioned, giving you an update on the communication activities that were part of the board's strategic communication plan. The attached timeline shows the planned activities through to June 30th, 2023. And we plan on providing an update roughly every 6 months, as Roberto mentioned. And the last update I provided was in August 2021. So the activities planned up to December 2021 included the development of a contract for a videographer, plan to reduce information and educational videos, provide additional webinars, further building our health fair, add a chat function to our website, and of course the social media. Unfortunately, of course, the pace of progress does continue to be impacted by vacancies within the department, specifically IT and our benefits division, and our focus on training new staff. So the contract for videographer, the Office of Retirement, we have researched and identified possible vendors for producing webinars and videos. The contract hasn't been developed as of yet, but staff have started the work of developing and reviewing the scripts for the videos and webinars when we are ready to begin. The plan to produce educational and informational videos, we're currently also working on our scripts and approving scripts for the videos. And of course, I've just mentioned an outside vendor will be considered to actually produce the video. Then for our additional webinars, we did hold a series of webinars, including our retirement route counselling, in addition to our retirement planning workshops. And we're planning on developing a recorded version of those sessions to be available on the website. The webinars currently available on the website cover insurance topics, open enrollment, vision, and our Delta dental insurance. Then we had our plan for additional webinars and videos. We have identified several topics, including, transitioning to Medicare, thinking of retirement, change of address, reporting a death, divorce, and reciprocity. They haven't been created, but they will be made available when they are created and put up on our website. The chat feature, this has not been implemented yet due to staffing, but as just Roberto mentioned, we are hoping to get those additional resources for the benefits group. And once those are trained, these resources will help provide the additional support to handle the increased incoming member requests. We do plan to post a state of the retirement system address video later here in 2022. Other activities that we did manage to complete, of course, there's our Retirement Connection newsletter. That's our quarterly newsletter. The next one will go out in April 2022. We do continue to use email and our social media. We post regularly to our Facebook and Twitter accounts. These accounts were launched last year in May 2021. And typically we plan to post around 2 to 3 posts every weekly. And so we are seeing an increase in the engagement in the photo or on the pages. So that's good. And then we're hoping to, for this next year, maximize opportunities to promote the social media. And that concludes my update on the communication strategic plan.
Great, thanks, Barbara. Floor is open. Any questions or comments for Barbara? We're not going to vote on this. It's just an update. Everyone jump in.
Yeah, hi, Barbara. This is Howard. Thank you for the work. Just in terms of feedback, you mentioned engagement on the website. Is there any other feedback from the members on the website, chat, social media?
No, periodically we'll get some feedback of someone that was pleased with a post or enjoyed a post. I mean, not an abundant feedback though.
Okay, well, great. Well, thank you. It's a good plan. Good work so far.
Thank you.
Anybody else want to jump in with Barbara? Okay, well, good news is we're on the home stretch. That was the last, I hope, material piece of the board meeting. I warned you at 8:30. This is going to be a long one. Harvey, are you ready to do AB 361? I got to lead it off. Actually, you lead it off. You go first.
I'm ready to channel Maytag.
There you go. So you lead it off, and then I'll make the motion, and then we'll do something.
All right. You have backup material with some factual findings that have not changed since the last meeting. Based on those factual findings, 2 of them are the most critical ones for being able to continue to operate under AB 361 remotely, as we have been doing, at least for the next 30 days. The first is the governor's proclamation of state of emergency due to COVID remains in place and is presently continuing and unchanged. The second is that the city council's resolution from February continues to either impose or recommend social distancing measures in city facilities. And so on that basis, Mr. Chairman, if you would ask for a motion to make those findings, and on that basis, elect to use AB 361's teleconference abbreviated provisions for the next 30 days.
Thank you, Harvey. I'll read my script. Based on the information just presented by council and provided with our board back materials, it appears the following factual findings justify our continuation of virtual meetings under AB 361. First, as Harvey said, the governor's proclamation, the state of emergency continues due to the ongoing COVID-19 pandemic, although may not in a couple of weeks. And 2, San Jose City Council's recent resolution continues to impose or recommend measures to promote social distancing in city facilities. So can I get a motion to adopt these 2 factual findings for the election, to use AB 361's abbreviated teleconferencing procedure for the next 30 days for this board? Do I hear a motion?
So moved by Santos.
I got a motion by Santos. Do I have a second?
Second, Gardner.
I got a second by motion by Santos, second by Gardner. Let's go around. Andrew.
Aye.
Sunita.
Aye.
Howard.
Yes.
Dick.
Yes.
Franco.
Aye.
And Dave.
Dave had to go.
Okay, that's fine. Thanks, Franco. This is Chair Lanza. I vote aye. On to section 5, the service requirements. We have in front of us 1, 2, we have in front of us only 4 service retirements. Karen M. Augustine, firefighter, fire department, effective Jan 31, 2022, 27.29 years service. Angela Jacobs, battalion chief, wow, fire department, effective Jan 28, 2022, with 26.33 years of service. Brian B. Williams, police officer, police department, effective March 8, 2022, with 25.00 years of service. And Mark T. Womack, police officer, police department, effective March 19, 22, with 25.03 years of service. Do I have a motion to approve these service retirements?
So moved by Santos.
Do I have a second?
Second, Votto.
Motion by Santos, second by Votto. Let's go around the table. Andrew?
Aye.
Sunita?
Aye.
Howard?
Yes.
Dick?
Yes.
Franco?
Aye.
I'm Chair Lanza. I vote aye. Andrew, Dick, Franco, want to say anything about these folks?
Well, Santos, of course, the wish of nothing but the best, and be safe.
As Andrew, I echo the same thing. Worked with both of these people. They're wonderful additions to the fire department family, and thank you for serving the community, and enjoy your retirement.
Any words, Franco?
Yeah, I worked around both those guys, and I wish them the best of luck in retirement.
That's great. All right, we've actually got an unusually long list of members that passed away. So I'll read this list and then we'll have a moment of silence. Notification of death of Edward Cutter, fire inspector, retired September 3, 98, died December 11, 21. Survivorship benefits to Janice Cutter, spouse. Notification of death of Stanley Jones, fire captain, retired Jan 5, 03, died December 14, 2021. Survivorship benefits to Linda Jones, spouse. Notification of death of William C. McLean III, police officer, retired May 5, 2001, and died Jan 22, 2022, leaving no survivorship benefits. Notification of death of Kevin Nishita, police officer, retired July 17, 2018, died November 27, 21, survivorship benefits to Virginia Nishita, spouse. Notification of death of Leland Peterson, fire captain, retired October 3rd, 96, died Jan 8, 22. Survivorship benefits to Sandra Peterson, spouse. Notification of the death of John Porter, police officer, retired May 3rd, 97, died December 28, 21. Survivorship benefits to Gloria Porter, spouse. Notification of the death of Larry Torkelson, fire captain, retired August 5, 95, died November 28, 21, survivorship benefits to Beverly Torkelson, spouse. And finally, notification of the death of David Williams, firefighter, retired December 4, 91, died Feb 7, 22, leaving behind no survivorship benefits. We'll now have a moment of silence. Thanks. Andrew, Dick, Franco, any comments with these folks?
Yes, Dick Santos. It's always painful, but I was real close to a couple of these guys, and it's even more painful. It's sad, the best of their families, and they did a great job, and we miss them all. And I'm not talking about the police officers and the firefighters. Thank you.
That's great. Anything from you, Andrew or Franco?
Yeah, this is Franco. I just, I hate to see lists so long. Especially Kevin Nishida, who I was actually on the board with years ago. He was actually shot and killed, and it's just very tragic that after putting all that time in law enforcement, he retires and ends up, such a tragic event. So it's my best wishes out to his surviving spouse and everybody else's families.
Thanks, Franco. On to committees. Let's see. As far as not here for the investment committee, there's really not much of an oral update. We covered at the investment committee the two things we covered here at the board. One was picking the right asset allocation mix, and the other one was pre-funding by the city. So let me note that we received and filed the minutes of Jan 6 and December 17. Audit committee, Sunita, anything to report?
Yeah, we did have a joint committee meeting after we met last time here, and there's a very big agenda from Human Husina. He does a really good job running us through a bunch of different things, all of which have been attached here. I think there was a pensionable salary and recommendation for pay codes. There was a materiality threshold discussed on how much error we're able to take. And he also provided a status of audit recommendations, a new report, and also the results of the staff survey. I don't know if either he or Roberto want to add anything to that, but I thought it was very productive.
Yes, thank you, Sunita. I defer to Human, obviously, if he has some comments. I think the survey, the annual survey is very helpful just to get a sense on how the staff is feeling about, in general, the office. Obviously, there's some pandemic fatigue and everything else. It's interesting, right? When I saw the survey results, and I'm hoping that each one of you get a chance to go through it. My first reaction was that I felt better because I feel it was more positive than prior year. But then, Human, as the senior auditor, has to find a way to bring you back to earth, and indicating that's not quite the case. But we just have a different view, I guess, on that. But I think it's a very good survey to get a feel for what's important and what's happening at the staff level. Never forgetting that the main goal when the senior auditor engaged in that staff survey is to help him or her prepare. We do have a 5-year plan, but to concentrate on some areas over others and make decisions going forward if he feels that she should bring some of that plan earlier, because some areas should be reviewed sooner rather than later. So it's really more for making plans going forward, but it does offer a sense or a feel for the engagement and the staff in general of the office. Human, I don't know if there's anything that you want to add to that.
No, thank you, Roberto. I think that pretty much sums it up. Thank you.
I mean, I just wanted to add that 7 out of the 9 dimensions the staff were surveyed were significantly up in the positive direction. It's only 2 of them which were down. So I mean, I thought it was a very telling positive survey. So anyway, I just want to receive and file all the presentations from Human, and also the minutes of the January 6th meeting and the October 21st meeting of the audit committee, just for the record. Nothing else.
Drew, you're mute, but if I could.
Thanks, Sunita.
Thank you, Sunita. I do want to publicly thank the staff, right, for their work throughout the year. They are committed, they're engaged. We wouldn't be here if it wasn't for their work. So I don't ever want the boards and the members and the public in general to forget the staff. And second, I also want to call attention to the work by our senior auditor. It's not easy to do audits. It's actually more challenging in this environment to work on audits. He has a very strong background. I think he does excellent work. And we're very happy to have him on board. I think that, this is a tedious process. We are going to be initiating, as I mentioned during my audit report, a hybrid approach to start bringing staff to the office. But nevertheless, I think there's a lot more work to be done, and I think we're on the right track. So again, I want to also publicly thank him for his work. So thank you.
Great, thanks, Roberto. Let me echo what she said. We received and filed the long list, 7 different documents that her committee has generated. Governance, over to you, Franco.
Yeah, I think the only thing that we had from the previous meeting was what we already discussed earlier, so I don't think there's anything new.
No, that's great. Thanks, Franco. I'll make note that we receive the minutes of the Jan 6th meeting. Disability Committee, anything to report, Dick?
No, instead of the Monday, we're going to be doing a special, doing some traveling, some different issues on March 15th. And so everything else is in order. Thank you.
Yeah, thanks. That's due to me, Dick, but I'll be down in San Diego presenting with Prabhu and Roberto Calipers. So
well, you're always there for us. We appreciate it.
Yep, great. Let me note for the record that we received and filed the minutes from Disability Jan 6 and Jan 10. Andrew, anything Joint Personnel Committee?
I'm on mute. No, we just continued reviewing the CEO and CIO performance process, keep tweaking it. We do have a meeting tomorrow. I think it might be canceled though.
Yeah.
Yeah, let me, if you don't mind, Andrew, jump on that.
Yeah.
I will be following up later today with the communication. We do have a scheduled meeting tomorrow. Unfortunately, we don't have, at this point, we do not have a quorum for a federated, and for the committee to actually meet, they have to have joint quorum from both sides of the equation. So if that would be the case, it wouldn't allow them to take any action. They can still meet and discuss issues, but they couldn't take any action. We are still considering having a very, very short meeting to, at the very least, approve the AB 361 so that you have the option of having a meeting later on virtually. Remains to be seen. We may be able to do that and have 5-10 minutes of discussion of some item. But in essence, what it will be just similar work to what you see here for the CEO, but for the CIO. That's what's scheduled for the JPC tomorrow. But you are correct, Andrew. This is the work by the CEO. Once all the work is completed, we'll bring everything back to the board. It needs to be done because this is the process that is going to be implemented by your boards for the current year that is ending on June 30th for the evaluation of your CEO and CIO. So thank you.
Thank you.
Anything else, Andrew?
Nope. Thank you.
Let me know. We're receiving filed the minutes from the Jan 6 meeting. Anybody want to add anything for next month's agenda besides what we're doing on the felony forfeiture thing? Floor is open. Board members, staff, public, any comments?
I do have a comment, staff.
Sure.
You did approve AB 361 here this afternoon because they're good for 30 days. That takes you to April 2nd, which is a Saturday, and your board meeting is going to be April 7th. I don't know what's going to happen with the governor, but if April is a meeting that your board is considering having virtually, and I guess I will defer to council, you probably will have to have a special quick meeting to approve another AB 361 that would take you 30 days past that April 7 meeting so that you can have it virtually, assuming that whatever changes are made, it still allow you to do that. So I don't know if Harvey has any other.
Yeah, unfortunately, that's what we will have to do to be able to extend it because the 30 days won't reach. So I would suggest that we do that sometime before the 15th to be really sure that we can meet remotely in April.
So, yeah, hey, Linda, let's get, what'd you say? What day was the board? The 7th? Roberto?
Yeah, April 7th. So we'll check with council. We will have to have a special meeting, and then we'll reach out to some of you, to all of you with a quick survey. All we need is enough for a quorum, and it will just be related to AB 361 so that you could do that. So we'll try to follow up on that.
Yeah, let's go ahead and do. I've talked to many times. Let's do that. By the way, guys, part of that's for me. I've got a long planned vacation. I'll be out of town. I've kind of personally asked our first meeting in person if I can be there, especially if we're going to be covering anything on felony forfeiture, which we will. So I sort of beg your indulgence on this. I think that's a very weighty issue. If we're going to be in person, I really want to be there. That's it. No more comments. We're going to adjourn. Okay, we're going to take a minute. Stay online, everybody. We're done. They're going to reset the tapes, and then we're going to go through our committee level AB 361 drill. So we stay on.